everyone, good morning, good afternoon, good evening to all of you. Welcome once again to this live analysis. स्टार्ट करते हैं आज का सेशन. फिलहाल के लिए देखोगे क्रूड ऑयल को तो मॉर्निंग से बुलिश ही था. मॉर्निंग पे वही परसों के लेवल पे ओपन हुआ था, सीधा ब्रेकआउट ही कर दिया साइडवेज जाने के बाद. देखते हैं वापस नीचे रीटेस्ट के लिए आता है. यहाँ पर एक छोटा सा रेजिस्टेंस जोन है, फिर से सेल कर सकते हैं. अगर अपर लेवल पे आता है तो नीचे एक बाइंग का प्लान रहेगा. नेचुरल गैस भी बुलिश ही है, ये भी परसों का रेजिस्टेंस था, वहां से नीचे सेलिंग आई, क्लोज होते होते सपोर्ट पे क्लोज हुआ. फॉरेक्स में फिर बाइंग आ गई थी, रेजिस्टेंस ब्रेकआउट हो गया एंड मार्केट मूव्ड अपसाइड. एंड अभी देखोगे तो इट इज कंप्लीटली बुलिश. फिलहाल ऊपर कोई मेजर रेजिस्टेंस तो ऐसा नहीं है. यहाँ पर एक छोटा सा एक सपोर्ट था, सीधा उस दिन इन्वेंट्री आई थी, ब्रेकडाउन हो गया, तो उसका एक रीटेस्ट कर सकता है. एक मेजर रेजिस्टेंस आपको फिर 308 और 10 के बीच में दिखेगा. नीचे मल्टीपल सपोर्ट बने हैं, थोड़ा संभल के करना. नीचे 297 एंड 295 दोनों ही सपोर्ट हैं. नीचे वाले पे आ जाए तो बेटर है, हो सकता है यहाँ से भी रिटर्न कर जाए. इस रीटेस्ट से थोड़ी क्वांटिटी कम ही रखना. मतलब रीटेस्ट है, ठीक ठाक ही है, बट इट इज़ अ रीटेस्ट, नॉट अ एग्जैक्ट रेजिस्टेंस. बाकी लंदन सेशन ऑलरेडी ओपन हो गया था. न्यूयॉर्क सेशन 5:30 ओपन होगा, 7 PM यूएस मार्केट की ओपनिंग. उसके अलावा कोई डेटा नहीं है आज के दिन, तो उसका भी ध्यान रखना. देयर इज नो डेटा शेड्यूल फॉर टुडे. बाकी देखते हैं और मूव करता है तो. इज आई एम ऑडिबल? मेरी वॉइस आ रही है आप लोगों तक? लेट मी नो इन द कमेंट बॉक्स अगर मैं मेरी वॉइस क्लियर है तो. आई थिंक वॉइस आ रही होगी क्लियर. क्लियर आ रही है. देखते हैं कुछ डेटा अगर आता है. 5:30 ध्यान रखना, इंपॉर्टेंट रहेगा. 5:30 का टाइम. 2 पॉइंट सेफर साइड पर चल देता है.
Decisions of, do I source my products from abroad, like currently potentially, or shift more of that to the U.S.? I think that's a very plausible outcome. Is you're going to get more domestic production, more activity in the U.S. over time.
Tom, tariffs aren't going away, and the president almost seems emboldened now. We're seeing some rates that are higher for some countries than they were on April 2nd. But after April 2nd, we saw a reaction in the market. Do you think the market at some point will start to push back?
So I think on the bond market, it's been a pretty range-bound year, and pretty interesting to think about what some of the catalysts have been for some of the shifts in the range. You were just talking about the 30-year Japanese government
Progress
bond moving
never
up,
stops.
but Friday's move in the U.S. was pretty big. I'm not really sure if it was that the market got around to reading Governor Waller's speech on Thursday, which talked about having a much lower duration balance sheet. But you've had these yins and yangs of kind of shifting the market winds. Initially, it was fears of inflation, and then the market got okay with some of the inflation prints and thinking maybe tariffs weren't going to be so bad. We think it's more of a delay here on kind of the bond market, recognizing if the economy's okay, which I think the data has definitely borne out the last couple of months in terms of activity, and you start to get inflation here. Are these fair levels of yields to compensate investors for maybe the Fed not having to cut this year, and then the long end having to deal with all the issuance and the supply and the inflation risk kind of continuing for a couple of years here.
Tom, we saw equity markets do well following the pandemic with a pickup in inflation. Nominal growth exploded. Tom, I wonder from your perspective whether you'd expect something similar or if it's slightly different this time, and in what way?
I think in terms of getting exposure to a nominal, like you say, John, a nominal asset, equities are great, particularly to the extent that they can kind of keep margins high and pass some of these costs on to consumers. I think the global economy, we think, is in this kind of swim lane of higher nominal growth than it was in the previous decade. So we think that's continuing. We think it's broadening this year. Equities are a great asset to capture kind of that expansion. There's a bit of a TINA element potentially here where people look, they're like, bond yields, do I really lock in 4-something% with inflation heading above 3 again? Or do I lever myself again to kind of the asset that's going to give me exposure to that growth? And also, companies have been super nimble about dealing with these tariffs. There was a news last week about Delta moving engines like across borders.
Yeah.
I wouldn't underestimate the ability of U.S. corporates to navigate these and find ways to kind of deliver shareholder value back.
Tom, what you're saying, though, I think is important. Just a final question. There is an underlying assumption here, and that it's the traditional inverse correlation between stocks and bonds reasserting itself. How convinced are other people by that idea, given the dynamics we've seen over the past few months?
So across the BlackRock platform, we're seeing less and less of a conviction that we're headed back to that negative stock-bond correlation. We're seeing lots of flows into diversifying liquid alternatives that are navigating kind of these equity blips a little bit better than bonds. And I think part of the reason why that positive correlation between stocks and bonds has been so sticky and persistent is it's related to kind of this inflation risk, the institutional risk. Historically, that's when you see that correlation shift to be more positive. And I don't think anyone thinks we're going back to kind of a QE ZIRP type environment, which is kind of the ideal environment for that diversification from fixed income. So broadly, we're seeing kind of investors, shift assets to speak to that kind of higher correlation between those two assets, which means it's harder to find diversification in your portfolios. And that's what investors really want to find these days.
Tom, thank you, sir. Appreciate it. Tom Becker there of BlackRock, giving us plenty to think about. Might also speak to some of the moves we've seen in gold and in Bitcoin over the past year.
You raise a really important point, which is what is the counter-cyclical response of bond markets at a time where a lot of governments have already been borrowing a lot of money? Can they borrow more to have a fiscal response to that negative growth shock, that whatever it might be when it comes down the pike? And if they can't, what does that do to bond yields and that inverse correlation?
Bond yields this morning only higher by a single basis point, the 10-year 4.42. With an update on stories elsewhere this morning with your Bloomberg Brief, let's cross over to Yahara, who has more. Hey, Yahara.
Hi, John. We start with our top story. President Trump declaring a 30% tariff rate for Mexico and the EU. The new rates are set to take effect on August 1st. EU Commission President Ursula von der Leyen responded saying they are working towards an agreement but are prepared to use countermeasures, while Mexico's economy minister called the new levies unjust. Meanwhile, President Trump and his allies are ramping up pressure on Fed Chair Jay Powell. In addition to criticizing Powell for not cutting rates, they're now focusing on his handling of the renovation of Fed headquarters. The Fed says the renovations are designed to reduce costs by consolidating its operations, but critics are focusing on what they call extravagant design features. And Amazon's Prime Day sale, which was doubled to 4 days this year, helped boost overall online spending in the U.S. by 30%. The data from Adobe included sales for Amazon and its competitors Walmart and Target, which hosted their own sales. Consumers mostly stocked up on household items rather than pricier goods like electronics. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later this hour. Up next on the programme, EU tariff tensions.
The European Union is talking to us. They want to open up their country.
We must prepare for all outcomes, including, if necessary, well-considered, proportionate countermeasures.
That conversation up next with Henrietta Trace of Vader Partners, live from New York City this morning. Good morning.
Progress never stops, neither should you. At PwC, we make sure you're ready for what's next, with the expertise and technology you need to outthink and outperform. We're with you, sleeves rolled up, start to finish, so you can stay ahead, so you can protect what you built, so you can create new value. We build for what's next, so you can get there now. PwC, so you can.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
A quiet start to the week. It gets busier tomorrow morning. CPI 8:30 Eastern Time, Tuesday morning. Sandwiched between a lot of bank earnings Tuesday and Wednesday. Equity futures right now negative by a third of 1% on the S&P. We're down by 0.4 on the Nasdaq 100. Under surveillance this morning, EU tariff tensions.
The European Union is talking to us. They want to open up their country. I would say Japan to a much lesser extent in terms of opening up their country. South Korea wants to make a deal other than tariffs. So some of these deals, maybe I'll change them and maybe I won't.
So here's the latest. The European Union preparing to respond after President Donald Trump threatened 30% tariffs on the bloc as talks with the US drag on.
I intend to speak with my U.S. counterparts again later today. The current uncertainty caused by unjustified tariffs cannot persist indefinitely, and therefore we must prepare for all outcomes, including, if necessary, well-considered, proportionate countermeasures to restore the balance in our transatlantic relationship.
Joining us now is Bloomberg's Tyler Kendall. Tyler, the EU versus the US, it was all very, very quiet. Now it's got a lot louder.
Yeah, exactly, John. Although it is perhaps the EU taking a more measured response here going forward, saying that they will delay their own retaliation until August 1st in a bid to keep negotiating with the U.S. But it was interesting to hear. You heard the EU trade chief there. He went on to tell reporters that there is a new sense of urgency, in his words, for the trading bloc to engage with its other trading partners. And Bloomberg News had reported earlier this morning that contacts with nations, including Japan and Canada, could lead to potential coordination between them against the United States. We know that the EU Commission President Ursula von der Leyen will be speaking with her Canadian counterpart, the Canadian Prime Minister Mark Carney, later on today. It's also probably worth mentioning that the EU actually reached a preliminary trade framework with Indonesia over the weekend, as EU officials have said perhaps there could be more of a focus on Southeast Asia and the Pacific. This tariff letter from President Trump really did appear to dampen perhaps the negotiations, considering our understanding had been that there had been progress and that the EU was moving up in line when it came towards the potential for a deal. The thing is, as you well know, there are just so many sticking points here. We know the U.S. has wanted to see greater market access for its agricultural products, for one example, and the EU has really been focused on those sector-specific tariffs. John, we know there is an emphasis here when it comes to autos, but it's also probably worth pointing out that some of the tariffs that haven't even been enacted yet, those tariffs under Section 232 on the grounds of national security concerns that we are still waiting for, like pharmaceuticals, are also still hanging over these negotiations.
Tyler Kendall with the latest in Washington. Tyler, thank you. To Tyler's point, still waiting for the sectoral tariffs from the White House.
Exactly, and they have been signaled from this administration a number of times. We did get copper, we have aluminum, we have steel, but what's going on with chips and what's going on with pharmaceuticals? And for some trading partners, like the European Union, like Japan, that almost potentially could be more important than the across-the-board, what they would call reciprocal rates.
Well, let's stay on Europe. Here's the view from Henrietta Trace of Vader Partners. Quote, there has been a split view in the EU over whether to retaliate against or negotiate with the United States. Since President Trump announced 30% tariffs on the EU, the retaliate team has been getting louder. Henrietta joins us now for more. Henrietta, welcome back to the show. That last word, retaliate, what about the prospect of coordination between the EU and partners?
You know, with trade, it's all about the negotiating partners, whoever the party is, expanding the cards in their deck. So if you can retaliate and you can also coordinate with other partners, all the better. And that's plainly what the EU is doing. And they are working, as Tyler just pointed out, to reach deals with Indonesia and other Asian trading partners to find a way to offset the, very clear permanent negatives that are coming from the United States in terms of these tariffs. And the only question I really have is whether the rate stays at 10% for them or whether it rises to 25%. And those sectoral tariffs are much more damaging and really create huge tensions within the EU bloc to negotiate. How do you strike a deal that works for autos but not pharma and leaves out Ireland, for example? Those are all the issues on the table.
Henrietta, when it comes to coordination potentially with Brussels and other capitals around the world, is it going to help or hurt their hand in Washington?
Honestly, I'm not sure how much worse it can get. They are holding off on retaliating. They did go back and forth for a couple hours yesterday morning, which was interesting to watch. As I mentioned, the retaliate team is getting louder. But I think that they are trying to deploy as many alternatives to the United States as possible to strengthen their hand. Because frankly, the president is not moving away from the tariff struggle. The market is giving him free rein to do so. And the EU basically has to do whatever it can to try to, increase the cards in its deck.
Well, is every card being used? Like the German defense minister visiting Washington today at the same time that Berlin is in talks with the U.S. about providing weapons for Ukraine and footing the bill?
Yeah, so the Ukraine component is, I think, a really big deal. And the president is under extreme pressure from not just the EU on that front and getting support from France and other nations saying that they're going to increase defense spending, but he's also under pressure from the United States Senate. And there are 83 senators or more who want a really robust sanctions bill to pass, which not only requires a 500% sanction that would go into effect on any nation helping Russia, but also would sort of hamstring the president in terms of what he can do unilaterally and force his hand. And that's exactly what the president does not want. So the EU does have some allies on its side when it comes to being pro-Ukraine and anti-Russia. And that's coming directly from, sort of inside the building from the United States Senate.
Henrietta, how cohesive is Europe right now when it comes to how to counter the United States? And I ask this as the German Chancellor Friedrich Merz said over the weekend that if 30% tariffs would go forward, it would hurt Germany's industry to the core, and so they would have to even postpone key aspects of their economic development plan, really kind of saying, look, we need to find another solution.
Yeah, and that's exactly the strategy of the United States right now. The purpose is to split the EU bloc. And I think if you talk to some folks in D.C. or in the administration, if that's their strategy, they wouldn't be mad at it. I mean, they want to go after very specific sectors to try to get Germany to exert pressure on Italy or to get Ireland to exert pressure wherever it can over pharma or France, whatever they can do on the agricultural front. So it's really about going after as many individual players. And that's why you have 232s across 8 different sectors right now, from steel and aluminum, which hits the EU, autos, pharma, coming on a whole host of other sectors, including aircraft and jets and engines. Those are all the levers that the U.S. is trying to pull to fracture the EU to the extent possible to eke out the best deal.
Henrietta, always great to get your views. Henrietta Trace there of Vader Partners. Headlines you don't expect to read: China, record exports, record surplus in the first half of the year, even with the trade relationship between the US and China collapsing, the exports from China to the rest of the world exploding.
Yeah, where in particular Southeast Asia, and you saw a 16% decline in exports to the United States. we have to dig in to understand exactly how much is going to Europe, and there are lots of people who will raise questions about the credibility of this data. But
as they should.
But there is this question about transshipments and how much of that exporting volume to Southeast Asia is just getting rerouted right back to the United States, and whether that's going to be something that the president can stop.
Exactly. For the month of June, it was down 16% going to the United States. But those Chinese goods are still somehow ending up in the United States. And I wonder if you're a U.S. official looking at this data, you're thinking, where do we need to go after when it comes to transshipping? They're trying to work this out with Vietnam. Who else?
Need to force it on everyone else for this to work. Equity futures right now in the S&P down by a third of 1%. Up next, RBC Capital Markets US head Vito Spadutto on the outlook for M&A ahead of earnings season. Plus, Yahaira with your morning movers. Fox getting an upgrade on its advertising pricing power. Live from New York, you're watching Bloomberg TV.
Progress never stops, neither should you. At PwC, we make sure you're ready for what's next, with the expertise and technology you need to outthink and outperform. We're with you, sleeves rolled up, start to finish, so you can stay ahead, so you can protect what you built, so you can create new value. We build for what's next, so you can get there now. PwC, so you can.
In France, when we do something, it often ends up iconic. This radio antenna, for example, iconic. Or a gift to a friend, iconic. A little something for breakfast, iconic. When we aim high, when we go deep. When we make hearts beat faster, and when we make them beat again. When we search for something, and when we find it. When we triumph, even when we stumble. Iconic. When we get people moving, when we get the world moving. Iconic. Why? Because we do things our way. Stylish, bold, exploring, innovating, carrying our history and values into the future. Make it iconic. Choose France.
The top names in business are on Bloomberg.
We view the tariff situation as something that will be resolved over the next 6 to 9 months. Even if you end up with a base level of 10%, divide that 10% up 3 ways, it doesn't have a huge impact on inflation in terms of global growth. It's something the world can absorb.
Nobody covers business like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 12 p.m. Eastern, right here on Bloomberg. Context changes everything.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
The capitalist system is the best system in the world. There isn't another one that works as well.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Wall Street used to be a place. Now it's more of an idea. I hope you survived the day.
I did. It was a busy day.
Equity futures so far in the S&P negative by 1/3%. A small week of losses on the S&P 500 last week. With Friday's losses, we just missed out on a third week of gains. A third week of gains would have been the longest weekly winning streak of the year so far on the S&P 500. On the Nasdaq, we're softer by 0.4%. Similar move on the small caps on the Russell 2000. With 2 hours until the opening bell, let's get you some morning movers with more. Here's Yahara. Hey, Yahara.
Hi, John. As you said, futures are lower, but I managed to find some stocks bucking that trend. And we start with Fox. Shares are up 3 3/4% after Wolf Research upgraded the stock to peer perform, pointing to the strength of Fox's news and sports businesses. They're saying that NFL broadcasts continue to deliver strong and stable audiences for them, and that they see no signs of an advertising slowdown for now. And we move on to shares of Synopsys. They are higher 3.5% after the chip design company secured approval from China to buy another company, Ansys, for $35 billion. The deal between these two U.S. companies needed Beijing's sign-off because China, as we know, remains one of the largest markets for semiconductors. And regulators there wanted assurances that Synopsys with this deal would not cut off Chinese customers. So a big hurdle cleared for them. And we end with some more optimism. Take a look at crypto-linked stocks, MicroStrategy and Coinbase, all higher, riding Bitcoin's latest move higher as it soars to record highs, reaching $122,000. And this is coming as Congress gears up for Crypto Week, where they plan to take on crypto legislation. John?
Yahara, thank you. Appreciate the update. On our radar this morning, our top story. President Donald Trump reiterating his call for lower interest rates, saying Fed Chair Jay Powell should quit. Administration officials also ramping up criticism of Powell's handling of an expensive renovation of the Fed's HQ.
They're throwing everything at him, and they're trying to find justification for why they can fire him, and the market is sort of shrugging it off and saying either this is just theater optics for some of the Kevins to audition more publicly, and maybe this isn't something that could actually change the dynamic of the FOMC just simply because it's not just a one-person FOMC. There are other members, too. To me, the fact that Kevin Warsh brought up a regime change for the Fed, talking about some sort of shift in the composition of the committee and overhaul, that made me take notice. Maybe that's just he wants to get into the front seat in this race.
That made me take notice to the fact that what they really do want is more seats to fill people that have their worldview, which makes me think that it is going to be someone like Governor Waller. Because if Powell decides to leave when his chairmanship is up, because he could stay until 2028, they want that seat for someone else to agree with people like Governor Waller that are currently on the board.
I've got no idea who's going to be chosen. But if you wanted a credible voice for someone making a credible argument for lower interest rates, he's on the Federal Reserve already. His name is Governor Waller.
If you put a Hassett in, I think the market will respond pretty dramatically because it will be considered somebody who is a political ally of this president. Warsh, you say the worldview. What is his worldview, considering that he was relatively hawkish? The bigger question is, how much does this affect the dollar more than even yields? Because it really goes to the heart of credibility of the United States. And if you start drawing too many parallels with Turkey, that's not a great thing.
Right now, it's not affecting anything. Bond yields are higher by a single basis point. Let's turn to trade. The EU planning to engage more with other countries hit by President Trump's tariffs. Sources telling us here at Bloomberg the bloc could potentially coordinate with Canada and with Japan. This is a change.
This is a change, and they're looking for leverage at the same time that they're trying to get the European nations to coalesce around some sort of plan of how they're going to counter the United States. This, to me, was one of the most interesting things. Henrietta Trey is really highlighting this is the strategy of this administration, to split the defense. This is sort of the classic football move to use, or soccer move. You want to try to create dissonance among the European allies so that they come together and actually have to accept it or negotiate and accept pain. I'm going to keep watching to understand exactly how they're doing that.
It's that forever question. If you're sitting in the White House, you want to call Europe. Who do you call? Who's answering the phone? Is it Ursula von der Leyen? Is it the German chancellor who's sending his defense minister to Washington today to talk about Ukraine and defense? Or is it someone like Giorgia Meloni, who we've seen had this outreach to the Trump administration, individual who's made her way to Mar-a-Lago before he wasn't even inaugurated? It's a challenging moment for the European Union because it really is hurting cats when you're dealing with all of these different countries.
You mentioned Germany and defense. Worth mentioning this story that the president is saying the U.S. will send more Patriot air defense defense batteries to Ukraine. His comments coming ahead of what he described would be a, quote, major statement on the war later on today.
So he said he haven't agreed on a number yet, but he said he's going to send these Patriot defense missiles. The big question going into today is, will he send anything that's more offensively? And also, when you have the German defense minister, Boris Pistorius here, they're the ones that are saying maybe we can help pay for some of this that's going to Ukraine. The second thing to watch for today is, does the president signal that he is in favor of this bill that is working its way through Congress? The number of Republican senators want to see, and this will make it much more challenging for Russia to export crude to China and India, basically the two biggest economies they're going to.
And by the way, does he link the two issues on trade and on defence? If we do this for the Europeans for Ukraine, what are you going to do coming back? And by the way, we don't like what we heard in a Bloomberg News story earlier this morning that you're looking to coordinate with trade partners to make it more difficult for us.
I absolutely think the president views all of this as one and the same. He will say, we are doing something for you on Ukraine. Now you need to help us when it comes to trade.
Three of the big stories so far this morning. Let's turn to deal making. The M&A market in focus ahead of a big week of bank earnings. Vito Spaduto of RBC Capital Markets saying M&A activity is delayed, not derailed, writing the backlog of M&A opportunities continues to build. Deals will happen. They're just not happening as quickly as many had expected. Vito, it's good to see you. Good morning.
Thank you for having me.
The difference between those two words, delayed and derailed. What inspires confidence that this is just a delay and not a derailment?
Well, I think the fundamental conditions have continued to be very solid. I think the corporates are sitting flush with cash, more so than they have historically. I think for clients, for instance, we're open to lend to clients to support their transactions, much like we were earlier in the year. I think people have gotten comfortable with the current environment. They are operating in an environment of constant uncertainty. And so when you talk about whether it's tariffs or other policy coming out of D.C., you have to plan for multiple scenarios. And so what we're finding with our clients is that they're preparing for transactions. There's a fair amount that they'd like to do. They're continuing their plans. It's just a question of when do you make the decision to do it. And so it's delayed to the right. It's not being taken off the table. And so I think there's a fair amount of activity when the window does open.
A lot of people said it was a wait-and-see economy, and then Delta Airlines happened. And Ed Bastian came out and said that things are stable, businesses have clarity, they're investing again. Have we broken out of that wait-and-see economy?
I think some have. I think we're seeing it certainly. I take a look very closely, for example, at the CEO Confidence Index out of the Conference Board. So the median there is 50 on a scale of 0 to 100 in terms of the inflection point. In the first quarter, which was taken in February, CEOs were at a 60, meaning that they were confident in the forward outlook. They felt positive about it. The survey that was taken in mid-May dropped to 34. It's the biggest quarterly drop that you've seen. So what happened between February and May? Liberation Day. So that tariff and policy uncertainty, concerns about geopolitical instability, and then also an uncertain regulatory environment in some cases has driven them to not make decisions. And so when they looked at that, a very high number of them felt that we were in a worse position versus 6 months ago, back in May. But what we are seeing is that, look, I think you look to Trump 1.0 versus this, it took a full year of the first administration for people to get their arms around what it meant. I think it's happening quicker now, and I think the better companies are prepared, and they're going to enact policy.
The pipeline is rich. The pipeline is there. Look, I think that one reason why a lot of people are looking at this is because we are going to get the earnings from JP Morgan and Citi tomorrow, and Wells Fargo, and then from Morgan Stanley and Goldman Sachs on Wednesday. And people are wondering how much of a boom this is going to be to them, considering that heading into this year, it was supposed to be the year of M&A. Didn't happen. How much has that been derailed?
Well, I think you're seeing, if you look at M&A volumes this year, announced volumes, it's actually up versus last year. But a lot of those transactions in the first quarter were things that were already on the books about to happen. And so you have U.S. M&A announced volumes are up 16% this year. Globally, it's up 26%. But it's really larger deals, $1 billion plus, are driving that. And the smaller deals, sub $1 billion, are actually slightly down in value. So what's happened is a lot of it's just been, like we talked about, pushed to the right. People should not be surprised by this. Like I said just now, this is what happened back in 2017 during the first administration. But what we are seeing is that where we sit today versus the beginning of the year is that there has been a tightening of the bid-ask spread. I think parties that are prepared and feel confident are out there doing transactions. I think sellers that need capital and need to, for instance, if you're a private equity firm and you need to return capital to your LPs, you're looking at various alternatives. It might not be a traditional sale, but maybe you look at a continuation vehicle. Maybe you're looking at some structured equity. Maybe you're looking at a minority sale or taking a loan on your net asset value. And you're finding ways to return capital because that's the lifeblood of what they need to do.
I wonder how much the scenario for how people are financing these purchases has changed with yields where they are. Have you seen people less willing, or companies, not people, companies less willing to incur debt to make those purchases and wanting to do it in all stock or crash or whatever, just simply because of the fees?
I think if you go back 2 years ago, a year ago certainly, I think people had not accepted this new level yet. I think they've accepted it now. So they understand rates higher for longer. I think if you look at where the calls are, for instance, our rate desk just pushed out their call last week that instead of a first cut happening in September, it's now going to be December. Just because it's too short of a window to August 1st or to the September meeting to really see any statistics that will
and also seeing their earnings go up at a disproportionate pace, according to what Neil Richardson is saying. They're the wealthier individuals, and they're continuing to spend, and they're continuing to spend on premium offerings at a lot of the airlines. And then you have the lower income consumers that are struggling. How do you deal with that when you look at the aggregate data showing a totally benign backdrop? And this is this is the conversation. How do you measure what is becoming an increasingly bifurcated economy, both from a corporate sector with the bigs and the smalls, as well as the economic sector within the consumer economy?
A record high in the equity market coming into Friday. We're pulling back this morning by 0.7% on the S&P. Coming up this hour, we'll catch up with John Stolfus of Oppenheimer, with stocks back close to all-time highs. Sami Sith of Raymond James on the airlines following Delta's bullish forecast. And Ed Al-Husseini of Columbia Threadneedle on the chances of a July Fed rate cut. We begin this hour with stocks lower as President Trump ramps up tariff threats. John Stolfus of Oppenheimer writing, our intermediate and longer-term outlook remains decidedly bullish. We believe U.S. economic fundamentals remain on solid footing. John joins us now for more. John, good morning.
Good morning, John.
So pick your favourite CEO right now. Jamie Dimon says it's complacency. Ed Bastian says we've got stability. Which one is it?
Somewhere in between. How's that?
That works.
It's bifurcated, and I think what we notice is related to market capitalization, style, as well as when you consider the sectors. There will be very big differences if the tariffs come out at the higher level among companies. Some will have great workarounds, some will be unscathed, and some will likely get hit. So it looks like a stock picker's market here, or even an index. You know, it could be better ultimately for technology and materials, for example, on expectations of what is to come beyond.
Let's talk about earnings. Max Kettner of HSBC, just in the past day, writing this, buy more. We increase our overweight to equities further and prefer the United States the most. Risk assets are set to remain supported with lower sensitivity to tariffs going into Q2 reporting season. Following Delta, did that bar come up just a little bit?
Yeah, I think the bar does come up a little bit when we look forward beyond. The later we get into Q2, I think, is when we begin to see perhaps some effect, at least in anticipation of what's coming forth. But our viewpoint has been for a long time that where we are today, it's be overweight U.S. We've been that way for years. We are moderately exposed, what we say is meaningfully exposed to the international, both developed and emerging. But we think it's the U.S. We don't think it's the end of U.S. exceptionalism. That's related to innovation, and also within, in terms of policy, is always a question if we consider the last 4 years and where we are currently.
President Trump yesterday, I just want to pick up on the comments that he made yesterday evening when he said, I think the tariffs have been very well received. The stock market hit a new high today. Does his getting a green light from the stock market make you feel good or nervous?
I think it makes me feel good in that I think the market is giving this some time. It's giving some consideration. We already had the great nervousness of April 2nd, and it had already begun on February 19th when the market began to move lower, and then it accelerated, hit a bottom on April 8th, and it's pretty much rallied since.
Okay, so then you reject Michael Hartnett of Bank of America, who said in a note this morning that really the complacency that Jamie Dimon was talking about has to do with stock traders' belief that Trump always chickens out, that ultimately he will back down and the rates that he's been putting out will be substantially lower. Do you think that that is true, or do you think that this market is adequately pricing in the rates as we've been hearing as they've been trickling out over the past few days?
I think thus far the market has been adequately pricing in the risks if it considers Scott Bessent's influence at the White House. And also, I don't think that where we are today is that it's not so much the taco business. It's much more that I think that Trump is sensitive to where the equity market moves. Believe me, I'm not an apologist for Trump. I wasn't an apologist for Biden either. It's just, if you look at it as a strategist, what's moving the markets is the market would appear to say there's enough workarounds that we have moving here, enough within the sectors, within the market capitalizations, within style. There's enough to take us higher. And where we are today is really a realization, I think, that an economy that is $28 trillion to $30 trillion a year, the U.S. economy, is likely somewhat bigger than policy until you get to a certain level. Now, we have to wait. If we go back to those April 2nd and we settle on those tariffs, that could be problematic. But if we see negotiations continue, and, on this whole tariff business, I'm not thrilled about tariffs at all. But what I think about tariffs is to bring people to the table. What it reflects is that the U.S. has the biggest consumer in the world, essentially, the U.S. consumer, versus overcapacity in manufacturing throughout the world, which has been built for the last 40, 30, 20, 10, 5 years, most of which has a destination to the U.S. and is hard to replace because of the per capita income of the U.S. consumer, whether it's a small consumer or a big luxury consumer. The U.S. beyond the billionaire class is global, and they compete for the latest Rolls Royce with the ostrich seats, But otherwise, when you look at the Ferraris, but when it comes to like the pencil sharpeners, the lunch boxes, whatever it is, the U.S. has the consumer that'll pay more. China can say they'll say, okay, you won't buy it, we'll sell it to the emerging markets. It's going to be tough. The emerging markets don't have the per capita income to replace the U.S. buyer. And when it comes to other countries, especially in Europe, they have so much cost of socialism built into their businesses that the hurdles they have to overcome. Their consumer isn't as big as ours.
John, this president wants rate cuts. Yep. Does this market need them?
I don't think it does. I'm a big fan of Jerome Powell. I think he's done a great job. 11 cuts, 9 pauses. 11 hikes, 9 pauses, and then 3 cuts. So far, no recession. Remarkable with inflation as sticky as it has been, and the target.
Is that genius or luck?
I think it's a combination of both. Again, I think it's never clearly bifurcated. It's like on this kind of thing, it's a mix. It just is. But I do believe that he's looking for his legacy is not to be remembered as the predecessor of Paul Volcker is remembered.
So, is there anything going forward if the Fed doesn't cut rates, you're not phased? If the rates that we're seeing in terms of tariffs go on, you're not totally phased. What would phase you heading into the end of the year at a time where a growing number of people are saying valuations are pretty high, a lot of expectations right now are baked in?
Yeah, I would say, it's if we see tariffs come in at those rates that are as high as they were on April 2nd, I think the market would have a real reaction.
But up until then,
even if it's 35, and I also
40.
think the Fed has room to cut. And I think the Fed is willing to cut. I think they're going to cut 2 or 3 times this year. I don't think it's what the highly leveraged crowd wants to see. But I think it's somewhere between 75 bips and 100 bips. Another down payment from the Fed saying the hike cycle is ending, but don't expect it. We're not going back to 1 7/8 mortgages. This is more normalized interest rates where we're headed.
Hey, John, it's good to see you. Thanks for dropping by.
Great seeing you.
Thank you, sir. John Stolfus there of Oppenheimer. On the Federal Reserve, it depends who you ask. If you ask Governor Waller, getting a very clear answer now, even with the recent labour market data, I think we're just too tight and could consider cutting the policy rate in July, then going on to say it's not political.
Yeah, saying that what he's looking at right now is the fact that tariff and the effect will not be a long term. It will be short-lived. I still
Take
can't.
Your pick.
So I'm trying to sort of do the in-between, the short-lived.
I just go with what's natural. Short-lived just feels right to me.
I would agree with you, but I think that he's looking through this and seeing it as short-lived, and other people are not so certain. Mary Daly, who is on this show, actually repeating that and reiterating some of that belief, and also seeing maybe 2 rate cuts this year.
Might see some dissent in a few weeks' time at that Federal Reserve meeting. We'll see. If you are just joining us, welcome to the programme. All-time highs at the close in yesterday's session. We pulled back this morning by 0.6% on the S&P. With an update on stories elsewhere this morning. With your Bloomberg brief, here's Lizzie Burden. Hey, Lizzie.
Hey, John. President Trump is threatening a 35% tariff on some Canadian goods. The tariff is an increase from the current 25% level and would take effect August 1st. It'd be imposed on US imports from Canada that aren't shipped under the terms of the US-Mexico-Canada agreement. Trump also told NBC News that he's eyeing blanket tariffs of 15 to 20% on most trading partners. Elsewhere, Apple is planning a release of a line of new products during the first half of next year, including a new low-end iPhone, multiple iPads and upgraded Macs. A budget smartphone dubbed the iPhone 17e will be a follow-up to a $599 model that Apple launched earlier this year. And London's Heathrow Airport plans to invest over $13 billion over the next 5 years to upgrade its terminals and its services after the UK hub slipped in global airport rankings. The project would increase the number of passengers per year by 10 million, a 12% jump in capacity. And that should be my brief, John.
Hey, Lizzie, thank you. More from Lizzie in about 30 minutes' time. Up next on the programme, the President emboldened.
The open question that maybe we're getting a little bit of an answer to is if you get enough resilience in economic data and the stock market trading at all-time highs, does that beholden the administration to sort of press forward with tariffs?
Up next on the programme, John Lieber of Eurasia Group, live from New York City this morning. Good morning.
Progress never stops, neither should you. At PwC, we make sure you're ready for what's next, with the expertise and technology you need to outthink and outperform. We're with you, sleeves rolled up, start to finish, so you can stay ahead, so you can protect what you built, so you can create new value. We build for what's next, so you can get there now. PwC, so you can.
In a world of seismic change, will your business shape the future or be shaped by it? How will we capture the imagination of tomorrow's consumers? Harness technology and AI to shape the way we live our lives. And unlock economic and social prosperity through environmental responsibility. With EY's full spectrum of services across sectors, we're all in to shape the future with confidence.
Things have been super volatile this year. Two-day winning streak on the S&P 500 into Friday, all-time highs. We pulled back again. We're down by 0.6% at the close on Thursday, though. Positive on the week by 0.02%. And if we close out the week in positive territory, the first three-week winning streak of 2025 so far. Isn't that unbelievable?
It is unbelievable because it feels like we've really kind of plumbed the depths of gloom and doom. And at the same time, there's been this buoy, and it has come in the form of big tech. And that continues today.
Pulling back just a touch this morning by 0.6%. Under surveillance, the president emboldened.
The open question that maybe we're getting a little bit of an answer to is if you get enough resilience in economic data, labor market data, you don't start to see a move higher with any, meaningful magnitude in the inflation data and the stock market trading at all-time highs, does that beholden the administration to sort of press forward with tariffs?
Here's the latest this morning. Stocks at all-time highs, emboldening the president to move forward with his tariff agenda. Trump telling NBC, quote, "I think the tariffs have been very well received." The stock market hit a new high today. Trump said he's now eyeing blanket tariffs of 15 to 20% on many trading partners. Bloomberg's Tyler Kendall joins us now from D.C. with more. Morning, Tyler.
Yeah. Hey, John. Good morning. Really, these latest moves signal no retreat from President Trump when it comes to the future of his tariff plans. And we have to look holistically at how these plans have really evolved over the last week. We now have President Trump upping his threat when it comes to the blanket tariffs. As you mentioned, they're up from 10%. That would be a significant difference, considering that we've seen outlined in the tariff letters sent so far that most of these rates are hovering around there, or at least just slightly higher. The second part from this week that we learned was President Trump holding firm that August 1st deadline is really the end deadline for these countries to negotiate, and then combine that with the future of sector-specific tariffs. Now, of course, the big escalation that we did get overnight was President Trump now threatening this 35% tariff on Canada. An official does tell Bloomberg News that USMCA exclusion is expected to remain in place. That's going to be absolutely critical moving forward here, since the bulk of U.S. imports from Canada are USMCA compliant. Data shows us that actually these sorts of imports have surged since the original tariffs went into place and were a threat back in February and March. They now make up about 60% of the goods that cross into the U.S. from the Canadian border. But still, John, this is not welcome news for the Canadian Prime Minister Mark Carney, who's been trying to leverage his personal relationship to negotiate with this White House. In a post on X last night, he said he would continue to work towards that August 1st deadline. But at this point, there are so many concessions that the White House wants. We're going to have to see if they're able to strike a deal.
Natalia, just before you go, the focus not just on trade, also on sanctions. We understand the president basically pre-announcing a big statement still to come on Monday. What are we expecting?
Yeah, so, John, basically this is going to be centered on a bill that is working its way through the U.S. Senate, led by Senator Lindsey Graham, that would ramp up sanctions against Russia. It comes as this White House has really expressed frustration in particular about trying to work towards a ceasefire when it comes to Ukraine. We have heard a shift in rhetoric from this president. In fact, when it comes to pledging more weapon supplies to Ukraine after there was a recent halt in those stockpiles, as the Pentagon said it was looking at its own defense industrial base and how it could replenish our weapons at home before sending them abroad. It's something that we're watching very closely and could have some big implications for getting Russian President Vladimir Putin to the negotiating table.
Tyler Kendall with the latest in D.C. Tyler, thank you. This president can be encouraged to change his mind, and it seems on Russia his mind has changed.
It seems as though he has been shocked by the discussions that he had with Vladimir Putin, and then several hours later, the assault that was foisted upon Kiev. I wonder, though, whether he'll pull the trigger. He was saying he would like Lindsey Graham to pass this bill and that it's up to him whether or not he's going to use it. It sort of leaves open the ambiguity that maybe he would back away at the last minute.
Equities this morning, elsewhere pulling back. We're pulling back from all-time highs on this quote from the president, an expensive one. Speaking to NBC, I think the tariffs have been very well received. The stock market just hit a new record high. Joining us now to discuss is John Lieber of Eurasia Group. John, welcome to the programme, sir. August 1st, big deadline, another extension. What is stopping this president from following through?
Very little. So far, it looks like these tariffs are a rousing success. Everybody, including us, thought that this would be quite bad for the U.S. economy. And you're just not seeing the shoe drop yet. Inflation's not so bad. Growth has been pretty resilient. You can quibble about some of the jobs report that just came out this month, but it looks like these tariffs are working. And I think importantly, nobody's really retaliated. So the Canadians haven't retaliated against him in a serious way. The Europeans have sort of backed off. The only country that did retaliate was China, and that got out of hand quite quickly. And that's led to what seems to be a pretty quiet truce that has taken them out of the crossfire, unlike all these other major trading partners, including Japan, South Korea. And as long as that continues to be the case, I think the president is getting the message loud and clear that, like your previous guest said, the economy can absorb a lot of these high tariff levels without a huge downturn. And I think that means he's going to keep going.
John, there's a message that you put in there that I thought was really interesting, that you thought that ultimately these tariffs are working. Working to do what? To raise revenue? Working to extract concessions from trading partners? What has been the goal?
It's making America great again, right? I think this is an exercise, in some level, this is an exercise of power. This is what Trump campaigned on, and this is what he wants to do. Now, the reshoring and the reindustrialization will probably take some time, of course, if that is going to happen. But I think that they're working in that the president can put them in place without any negative consequences, and the economy is doing great. So, if you think about it, the president's perspective and the White House perspective, this is a rebalancing of stuff that was broken in the U.S. economy for decades, and it was broken by previous leaders. And now Trump's coming in to rebalance it. And in that rebalancing that we've all been saying is going to be terrible for the outlook, it hasn't been that bad yet. So in that sense, I think that the rebalancing is starting to work in his mind, and he's going to keep going.
In his mind, it's not necessarily affecting the polls that much. You're still seeing a lot of popular support to not put tariffs on. And there has been a deterioration in the president's approval rating. At what point will that offer up some sort of check? Does that matter at all? Or is this a president that isn't going to run again, so ultimately those polls don't matter?
Yeah, I think that's right. Well, I think the polls do matter, but the basis is that he's got this very strong base of support in the Republican Party. His approval rating is still above where it was for basically the entirety of his first term. And because of that, it suggests to him that he's doing okay. So I think that he's losing support, but it's with voters he doesn't necessarily care about, and he certainly doesn't need because he's not going to run again.
I think it's a great test going into the midterms next year for the Democrats, for the other party, John, because the tariffs that the president introduced in his first term were criticised by the party on the other side, and then they kept them. And I just wonder, John, will anyone actually campaign on removing them if they get into power?
Yeah, I think it's really hard for the Democrats, as you just mentioned. I mean, I think basically on some level, they've been supportive of this kind of trade protectionist policy for decades now. And the reason for that is this is what the labor unions wanted. And now Donald Trump has sort of come in and stolen their base of labor union supporters. He's taken their policy and taken it to the extreme. And they're not really yet finding a way to articulate the case against that. And part of the reason is this economic resilience. Now, if there is an economic slowdown, if you do start to see job losses, layoffs, you get some bad job reports, that's good news for the Democrats. And they'll certainly lean into that and attribute it to the chaos caused by Donald Trump. But I think they're going to have a hard time campaigning specifically against these tariffs. And it's why any tariff wall he ends up building probably endures past his administration.
The data so far has been pretty decent. John, appreciate your time, sir. John Lieber there of Eurasia Group. The jury, arguably, though, still out. You hear a lot of people, many economists saying these companies built up a lot of pre-tariff inventory. They've been working through them. We still don't know what the pricing strategy is going to be in the months to come.
Just to build on that, a lot of these tariffs don't go into effect until August 1st. If
Own stocks, Red Cat Holdings up nearly 16%, while Kratos and Aero Environment is also up, and that is because Defense Secretary Pete Hegseth says that the U.S. is ready to unleash drone dominance. His plan is to fast-track drone production and push thousands of low-cost drones to troops in order for them to start testing them and training with them for combat. John?
Yahira, thank you. More from Yahira in the next hour. On our radar this morning, President Donald Trump ramping up the pressure on global trading partners, telling NBC News he's considering a new blanket tariff rate of 15 to 20%. Trump also threatening a 35% tariff on some Canadian goods.
Raises a question who he's negotiating with. Is he negotiating with the trading partners? Is he negotiating with the market? Is he negotiating with the budget deficit? The reason why I say that is because I was struck by Vietnam. They were surprised when he announced that they had agreed to a 20% baseline tariff rate and is continuing to discuss with them behind the scenes, the U.S. Delegates, exactly what that looks like and could it come down a little bit lower. They would have been okay with like a 10 to 15%. So it seems as though the trading partners have gotten a different message and maybe their response will be slightly different if they see these rates as plausible going forward.
That's my takeaway from the whole thing, was the last point of what you said. They'd be willing to accept something like 15%. That's a whole new world compared to where we were a few months ago. Not just them, but the Europeans also, willing to accept 10%.
There is a feeling that's fine. And you could talk about escalate to de-escalate. This is a president that sets the bar very high and then brings it down and makes it look like he's cutting a deal, but really he's extracted some concessions. This is why people call him an excellent deal maker. A real question, though, how far can you push it? And will he be willing to accept a 10 to 15% tariff rate if it is acceptable to them and if the market is chugging along, or is he going to try to extract more? And is that August 1st deadline going to be more of a risk event that a lot of people are talking about?
It's going to be an interesting 3 weeks still to come on the trade front. Interesting week still to come for Russia. President Trump planning a major statement on Russia for Monday. The president also saying he expects the Senate to pass a bill ramping up sanctions on the country.
And he will decide at that point whether or not he's going to sign off on that. I do wonder how much he has changed his mind, what could potentially happen over the weekend to influence him one way or another, and what this will do on the geopolitical stage. We were talking to Mike Pence yesterday, and I was really struck by what he said. He has faith that actually this time the president is going to take a harder line on Russia after seeing what happened to Kiev because he has been working with Lindsey Graham. It does seem like the tide is shifting, especially with respect to the calls around Vladimir Zelensky over in Ukraine.
It's certainly something that the Senator Graham has been pushing for over the last few years, that's for sure. I want to turn to these comments from the JP Morgan CEO, Jamie Dimon, not just on the economy, on financial markets, some very harsh words for the Democratic Party, saying members went too far in their focus on diversity, equity and inclusion. Dimon adding, and this is a direct quote, "I have a lot of friends who are Democrats and they're idiots."
And he went on to say they have big hearts and small brains, talking about some of their policies. They don't live in the real world. Some pretty harsh criticism. You could say a lot of things about this. You could take this in a lot of different ways. The way that I'm curious to see how this plays out is there are a lot of people who have affiliated with Democrats who are very critical of the party. How do they give a message going forward? Because what is the Democrats' message right now?
So I'm not going to make this about one specific company. I'll just talk about corporate America at large. And it doesn't apply to everyone, but applies to many. 5 years ago, they're kneeling in front of their emblem because they believe that helps them. 5 years later, they're trashing DEI. And I think many of these companies don't have values, they have sales targets. And they're willing to do whatever it takes to make people believe that these are our values, help us sell product. My issue with that is the winds of change seem to be influenced by who is in the White House at any given time. And that seems to be what all these stories are associated with. And now, for me personally, I didn't like the virtue signaling 5 years ago, and I don't like it now. And I think for many companies, let's take a bank. For me, for a bank, I don't care what your CEO thinks about these things. When I go to the bank, I want to know my money's there. And if I'm borrowing money, I want a really low rate. And if I'm depositing money, I want a really high rate. That's ultimately what I want as a consumer. Do I want the CEO of said bank telling me about what he thinks about politics here, politics there, values here, values there, if their values seem to change every election cycle?
It's a fair point. If you take it a little bit of a step further, right now on an international stage, the corporate executives in the United States are little ambassadors going around the world saying policy does not create what we do every single day. and they're trying to distinguish themselves with their own mini platforms. It's almost sort of this political structure that is really beholden in the corporate sector that is divorced from what's happening in Washington, D.C. There is a feeling Washington, D.C. is a mess. We have it together, and this is our policy platform. And it feels almost as though that's the pitch on an international level. And I wonder if this speaks to the international change in minds, because this isn't just a U.S. sort of shifting in the winds. This is a global one, and it has a broader appeal. And it's notable he was saying this over in the UK.
We've got earnings next week.
We do.
We've got earnings from JP Morgan next week. We're talking about thoughts on complacency around markets and DEI. And we're not talking about the actual numbers.
Well, if the numbers will come out and they'll have record profits, and it'll be great. That's basically what we've become accustomed to. You know, the world might be falling apart and lots of complacency, but
raise the outlook.
Yeah, but raise the outlook. $2 billion in profits.
The big banks reporting next week. Look out for that. Turning to the airlines, we've already heard from one. Their stocks are flying high after Delta delivered better than expected earnings and restored its full-year guidance. Savi Sith of Raymond James joins us now for more. Savi, welcome to the programme. Just fantastic numbers from Delta, reinstating the outlook, some real confidence coming from the CEO, Ed Bastian. Do you believe that is just a Delta Airline story or a broader industry story?
Hey, good morning, John. Thanks for having me. It's a little bit of both. If you look at the 3Q guide and the beats, there was definitely good cost execution from Delta, controlling what they can control. But the optimism that they're talking about really is driven by what the industry as a whole is doing. We did see demand kind of start to wane from the really strong levels you saw in December, January, as you went through April. And now we have stability. And what I think they're most excited about is just how much the industry's done to get supply to match that demand in the post-summer period. So it is an industry story, not just Delta. And then maybe as we get some level of certainty with the reconciliation bill and maybe with the tariffs, maybe that would kind of get the consumer and corporate some confidence to pick up travel again.
Savi, the way that we were talking about it yesterday was about a K-shaped consumer, and that certain airlines, particularly Delta, cater to that corporate class, have a lot of premium offerings, and can have much bigger profit margins that really bolster the rest of their earnings in a way that some of the other airlines, particularly the ones more focused on budget-conscious consumers, don't have. Is that a fair way to look at it?
Yeah, that's fairly. So if you look at it, the airlines that have more premium and corporate have been doing better through this kind of slowdown. But the interesting thing is, most airlines, their household income, the target consumer has a higher household income. The budget traveler is where I think Delta is seeing a little bit more excitement. Main cabin is where they're expecting improvement. Again, as supply starts to kind of meet demand. And then again, as maybe we start to see a little bit more certainty and confidence return.
When you keep talking about supply, essentially they're constraining capacity as a result of declining demand. And it raises this issue about price increases. Is that still the goal? Can they still raise prices on consumers, particularly in the main cabin, at a time where they're having to cut capacity in order to really right-size the supply-demand backdrop?
It's a mathematical equation, Lisa. What's happening here is you are taking the seats that cannot be filled at a decent margin off the market, right? So the average fares do go up just by the function of that. And what you need is demand improvement then to push prices higher on kind of the additional seats. So right now it's more about supply coming out and the average fare going up. And it's necessary because there are a lot of airlines that aren't profitable at all in this environment. And then hopefully as demand starts to strengthen, we'll be able to kind of pass through prices to also meet kind of the higher level of cost for airlines.
Savi, for many of us in this market over the last several months, things have felt anything but stable. They've been incredibly volatile. That quote that came from Ed Bastian, I just found absolutely stunning. I've been thinking about it ever since it came out. Just the idea that this environment can be described as incredibly stable. Savi, where is that coming from? What kind of stability does he see, and what is influencing it?
Yeah, it's definitely, as we kind of reflected on the second quarter, it was a quarter that a lot of things happened, but nothing changed from a demand standpoint. So you've seen kind of demand bottom, but it hasn't really changed. That none of the kind of the headlines stop demand from recovering. You see, green shoots of demand recovering, and then some headline happens, and demand kind of goes back to that stable level. So it's definitely interesting that demand has remained stable, which is encouraging. And what we're looking for is maybe a recovery from these levels.
Do you expect to see the same thing at United and American Airlines? Can they repeat what Delta Airlines did this week?
Yes, I mean, again, I think they're seeing the same trends. They have some unique geographic exposures, perhaps. But one thing I would say is, again, the third quarter, Delta's EPS guide beat expectations. Half of that came from cost execution. But the component that came from demand and the stability, I think that can be replicated at American and United as well.
Savi, appreciate it. As always, Savi Sitha of Raymond James on Delta Airlines. Not just a Delta story here, Bramo. Apparently this is an industry story.
Yeah, because they're right-sizing the supply-demand picture so that prices can still keep going up. She did say geographic issues, and she pointed out American Airlines as not necessarily being beholden as much to some of these trends. The geographic aspect of this is going to be fascinating. They're more focused in Latin America and South America and all of the Americas. And I wonder what the international travel backdrop is going to look like from all of these as sort of a read-through of the popularity of certain regions, differentials of FX, as well as different immigration policies.
AMH trying to get a direct flight from JFK to the south of Italy.
Evidently. Is that why she's off today?
Maybe. We'll see if she's successful or not. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Lizzie Burden. Hey, Lizzie.
Hey, John. Vietnam is seeking to lower its tariff rate by the US. Sources say the country's leadership was caught off guard by President Trump's announcement last week of a 20% tariff. Vietnam is pushing for a tariff more in the 10 to 15% range. Elsewhere, Israel reportedly believes that some of Iran's underground stockpile of enriched uranium survived last month's US and Israeli attacks. The New York Times cites a senior Israeli official saying some of the material may still be accessible. The same official says that Israel had uncovered a secret Iranian project to build a bomb late last year. And Tesla is planning to expand its robo-taxi service into California and Arizona after its recent rollout in Texas. CEO Elon Musk expects the driverless cars could launch in the San Francisco Bay Area in a month or two, pending regulatory approval. Tesla has also applied to operate in Phoenix, and a decision is expected by the end of the month. And that should be my brief, John.
Lizzie, thank you. More from Lizzie in the next hour. Up next on the programme, it's not political.
Given where we are with the labor market, given where inflation has been, I just made the argument, I think we're just too tight and we could consider cutting the policy rate in July. It's not political.
Up next on the programme, Ed Al-Husseini of Columbia Threadneedle, live from New York City. This is Bloomberg.
In France, when we do something, it often ends up iconic. This radio antenna, for example, iconic. Or a gift to a friend, iconic. A little something for breakfast, iconic. When we aim high, when we go deep, when we make hearts beat faster, and when we make them beat again, when we search for something, and when we find it, when we triumph, even when we stumble. Iconic. When we get people moving, when we get the world moving. Iconic. Why? Because we do things our way. Stylish, bold, exploring, innovating, carrying our history and values into the future. Make it iconic. Choose France.
Pulling back from record highs on the S&P 500 this morning, we're down by 0.7% on the S&P. On the Nasdaq 100, we're down by 0.6%. On the Russell, we are underperforming. We're down by 1.2% so far this morning. Under surveillance this morning, it's not political.
If inflation comes down, we can lower rates. We should not be responding to tariffs with the policy rate. And as long as the economy is doing okay, that's fine to lower rates. And if there's any blip up in inflation because of tariffs, you just look through it and keep moving. Given where we are with the labor market, given where inflation has been, I just made the argument, I think we're just too tight and we could consider cutting the policy rate in July. It's not political.
Here's the latest this morning. Fed Governor Chris Waller breaking with the central bank's wait-and-see narrative, floating a July rate cut. The president continuing his attack on Fed Chair Jay Powell, posting on Truth Social, too late, demeans the great credit of the USA, lower the rate. Adha Hussaini of Columbia Threadneedles writing this: the Fed's bias this year has been to react to incoming data rather than act proactively. They may end up looking for a huge rock to hide under in the second half. Ed joins us now for more. Ed, good morning. It's good to see you.
Good morning.
How political are things about to get in the second half of this year?
It's really tough because you have the fog of data that the Fed has to go through, in addition to this extraordinary pressure from the White House and, of course, the succession conversation early next year. So anything they do will have political undertones at this stage.
Any sign at all, from your standpoint, looking at markets, that we're beginning to bake in some kind of political premium in the yield curve?
You know, not yet. The yield curve, particularly the longer end of the yield curve, has been, I think, disproportionately focused on the fiscal premium and the fiscal story over the course of the past year. That's gone up noticeably. The curve is steeper. Real interest rates are higher. But we haven't seen it in, I think, the inflation market. And that, to me, would be the center of where any kind of deviation from Fed independence would start to show up first.
And part of the reason why you haven't seen that and why you've seen implied volatility in Treasury yields actually fall to the lowest level in about a year is because there's a huge economic debate about just how inflationary these tariffs will be. We've even heard members of the Fed, like Mary Daly, say it looks like they're going to be evenly distributed and they're not going to be that significant. You seem to disagree. Why?
Well, there is a conversation to be had around just how quickly tariffs will hit the economy. In the course of the last, I think, 4 or 5 years, we've relearned over and over again that various aspects of policy have long and variable lags. It was true with monetary policy. It was true with fiscal policy. We're about to find out that trade policy also has long and variable lags. And so I think committing to a view that the inflation story is going to be very short-lived, it's going to be very long and persistent, you don't want to do that this early on. And I think you want to have the flexibility. And I think the Fed has shown to some extent that flexibility at this stage.
You said in your recent notes that we could get a bump to core PCE inflation as a result of some of the tariffs that have been announced, up to about a full percentage point, 100 basis points by the end of this year. What would that do to markets? How offsides are markets to that type of reality?
Not that much. I think if you look at market expectations, they're roughly for about 50 basis points of cuts this year, 50 to 75 next year. If, in fact, the inflation story is front-loaded and relatively sharp, I think cuts this year will start to come out. Maybe we're down to 25. I think it's really difficult to fully price that out. So that gap isn't huge. The gap next year is going to be massive. And I think in my mind, this is going to be the core of the debate as we get into the second half is there room for the Fed to cut much more aggressively in the event that the economy slows, this tariff inflation story turns out to be transitory, or will they have to remain on hold for the entirety of the year to fight off an economy that's starting to overheat, fiscal policies in play, tariff inflation could prove, I think, and this is a risk, could prove to be a little bit more long-lasting.
Ed, I'd love to know what your base case is. Do you see that dual mandate in conflict as we work our way through next year?
Not that much. I mean, my base case is perhaps we're priced pretty much to perfection this year. I don't think we can do that much more. The economic data is held in quite well, particularly around the labor market. Next year, I see significantly lower terminal rate. So where the Fed's going to land. Right now, we're landing at about 3.25 in terms of Fed funds. I think there's significant room to land a lot lower, both as underlying inflation works through the tariff story, but also because the margin of error now around the labor market is exceptionally skinny.
Coming into this year, there was a belief that the U.S. would be more resilient than the rest of the world to any kinds of tariffs. That's reversed itself. Suddenly, the U.S. is the epicenter of pain, at least as implied by markets. Are we going to see it flip back, where people start pricing in a slower growth environment for developing markets, for other even developed nations that are facing off with the conundrum of how to deal with these?
Yeah, I mean, it's an incredibly difficult story. In some ways, when you think about trade, the U.S. is largely isolated. It's a relatively closed economy. Most large economies outside of the U.S., think about Europe, China, and so on, are significantly more leveraged to trade. So if global trade starts to slow, and that is not just trade with the U.S., but trade between those other countries starts to slow as a result of our trade policies, that's going to be significantly negative for growth. That is not in the price of the moment. Risk assets in emerging markets, risk assets outside of the U.S. have rallied significantly with the view that growth there is going to be good. I think there is some room for that to reverse, for sure. The longer the U.S. economy continues to perform, even if it's muddling through, risk assets here would be looked at as quite attractive and, if anything, a little bit cheaper now relative to the rest of the world.
Should we finish on some good news then? 2 auctions went pretty decently this week.
That's right.
We can clear some supply. It's a good thing, right? Buyer's strike.
I think the notion that there's a buyer strike in treasuries, I think it's very difficult to find in the data. I think it's very difficult to find evidence for the view that foreigners have stepped back from the treasury market. And I think what we're starting to see is the anticipation building that later this year, the Treasury is going to pull back in terms of supply in the long end of the curve and move most of that supply into the belly towards Treasury bills. I think that's becoming a very consensus view at this stage.
This is what Lisa's been talking about over the past week.
And ultimately, the supply-demand side of this story is going to dominate in the rest of this year. Let's just to caveat that a little bit, we are trading close to 5% yields on 30-year treasuries. This is a group of people saying maybe there's value in locking money in for 30 years at 5%. And, you know, if we lose a little bit, we can buy some more. It's not people saying, oh, it's a great environment. Let's buy. Let's go.
There's always a price to clear supply.
Exactly.
The good news, on a 10-year at least, is 4.38.
Yeah.
And not 5.38.
Correct. That's good.
And we'll run with that. All right? Ed, it's good to see you. Thank you, sir. Ed Al-Husseini there of Columbia Threadneedle. Coming up next on the programme, Emily Rowland of John Hancock, Jeanette Lowe of Strategas, Erica Najarian of UBS, Stephanie Roth of Wolfe Research. From New York, the second hour of Bloomberg Surveillance. Up next.
Progress never stops. Neither should you. At PwC, we make sure you're ready for what's next, with the expertise and technology you need to outthink and outperform. We're with you, sleeves rolled up, start to finish, so you can stay ahead, so you can protect what you've built, so you can create new value. We build for what's next, so you can get there now. PwC, so you can.
The economy has been stress tested by tariff ban, and yet it's passing the test.
The economy has shown relative resilience.
What we've seen so far is evidence that the news flow on the inflation front is okay.
Already you're seeing consumer spending stalling out.
You are seeing pressure on some of the lower end consumers. There is still some resilience, but it's more up the income spectrum.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning to you all. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures pulling back from all-time highs on the S&P 500. Negative so far by about 0.7%. On the Nasdaq 100, down by 0.6. The headline of the last 24 hours, this quote from the President of the United States. I think the tariffs have been very well received. The stock market hit another record high. The president looking at the equity market as an endorsement of his policies.
So this goes to a real question, and we have to ask this, and I don't know the answer. I'm going to be completely transparent. Does the market not believe President Trump's most extreme threats, is not pricing them in, or has it priced them in to some extent, right? Does this market believe that the president will back down from some of the more extreme threats eventually? And is that the reason why the market is not responding, a kind of game of chicken? Or has this market priced it in and realized it doesn't matter that much to an economy that is somewhat insulated to trade relative to the rest of the world?
Tough question. I'll use someone else's words to answer. Okay. Someone bullish, constructive on this market. Max Kettner, HSBC. Risk assets are set to remain supported with lower sensitivity to tariffs because Q2 reporting season is the key catalyst. The earnings have been okay. And I think investors are comfortable with things because so far, and I stress so far, and we can have a big debate about what things look like in the future, but just an observation about where we are. So far, the earnings are still okay. The guidance coming from the likes of Delta, pretty decent, and the data has held up. On output GDP, not great, but the labour market all right. And then you look at things like inflation, and we haven't seen that firm up in the way people thought it would over the past few months.
Take that a step further. If you can't have a crystal ball because things are so murky, do you end up just saying, we can't know the future, so we could just know the present, and the present looks fine, so let's keep going with that? Is that essentially what people in this market are doing because the future is too difficult to really parse through? And that is what we're seeing in economic data, even at the same time that there is a huge raging debate among economists about how much we could potentially price in tariffs that haven't even gone into effect yet, that will go in August 1st, really spotlighting next week's CPI report on Tuesday.
Whaley of BlackRock, I think, did a fantastic job of articulating this in the past week or so. If you're struggling to find macro anchors, and it's difficult at the moment, look elsewhere. Look to mega forces. AI. Look what Nvidia is telling you. Look what Taiwan Semi is telling you. I've repeated this all week. Look what Mark Zuckerberg is telling you. That guy's going to pay someone $100 million to do one job, around one theme. That tells you everything about what's really dominating the top of this equity market at the moment. That's where the gains are.
It tells you everything about what your major should have been in college and what jobs you should have gone into, maybe if you wanted to get that $100 million bonus. It does raise a question, though. How much are we kind of hitting thin air in terms of the concentration of leadership? Big tech taking massive flows, almost record flows over the past week, because people can bet on that theme at the expense of everything else. How much is that muddying the signal from a stock market that is so heavily dominated by that, at the same time that the Russell 2000, more representative of the broader economy, is struggling to catch up? And that, I think, is something people are grappling with.
And underperforming again so far this morning. The Russell down by around 1%, on the S&P negative by 0.7%. Coming up this hour, we'll catch up with Emily Rowland of Manulife John Hancock following fresh record highs. Jeanette Lowe of Strategas as President Trump floats higher tariff rates, and Stephanie Roth of Wolf Research on a bifurcated outlook in the C-suite. We begin this hour with stocks down on President Trump's latest tariff threats. Emily Rowland of Manulife John Hancock writing, in our view, US equities have the best chance globally of seeing positive earnings trends. It may have more room to run. Emily joins us now for more. Emily, welcome to the show. There was one line in your research that popped off the page for me. The year so far has been about politics and not profits. Is it about to change?
Yeah, John, luckily investors are going to be able to focus on something else other than political developments. There's a lot to take in, from the big, beautiful bill to tariff announcements. You can almost get stuck in analysis paralysis doing that. And luckily, we can focus on the fundamentals. It reminds us of that famous Bill Belichick press conference where he refused to answer questions about the loss to the Kansas City Chiefs and kept saying, we're on to Cincinnati. We're on to Cincinnati, and we're on to earnings season next week. Analysts are penciling in 5% earnings growth for S&P 500 companies. That's come down a bit, so the bar is lower. We're going from 13% earnings growth, just awesome results in the first quarter. This is going to be more about the haves and the have-nots going into Q2. So we're going to have to see which companies can deal with revenue growth slowing. Margins are starting to get compressed. Profitability here is coming under a bit of pressure. Those high quality companies that can maintain those margins in the face of some of these headwinds, we think are going to be the relative winners as we head into the back half of the year.
From a true Patriots fan sitting in Boston, I'm sure.
That's right.
Just to follow up on some of that and not the sport, the division between Europe and the United States. Do you see it flipping the other way in the next half?
We do, John. And there's just been this unbelievable outperformance of non-U.S. equities. European stocks are up double digits. A lot of that, of course, has been helped by the weaker dollar. But meanwhile, we've seen better relative economic growth in the United States and better relative earnings growth in the United States. This has been a big story around sentiment, capital flow shifting into Europe, a sell everything America trade. It's almost just like the U.S. is just getting a participation award, but Europe is really just outperforming and shining here. We think that potentially reverses again as investors can look at the fundamental backdrop, look at where better relative economic growth is coming in, and reallocate assets to high quality stocks in the United States.
I'm picturing the U.S. equity markets with the Rocky soundtrack in the background, kind of trying to get that, gold medal.
Yeah.
But there is this question going forward: how much is this entirely driven by the big tech sector in the United States versus some overall optimism about the growth trajectory?
Yeah, the concentration risk is a worry again. The top 10 stocks in the S&P 500 back up near 40%, and the valuations are egregious. I mean, the U.S. S&P 500 growth index is trading at almost a 50% premium to its 20-year average. We still like tech. As you know, we've been overweight technology stocks in the United States for over 5 years. And because the earnings engine is on there, but you've got to find those quality stocks at a reasonable price. You've got to protect against the valuation risk by owning things like mid-cap stocks, which are trading at the largest discount to their large cap counterparts since the late 1990s. We're looking at areas where you can find quality at a reasonable price. That's leading us to healthcare, utilities, industrial sectors, communication services. We're looking closely, I don't want to get too nerdy here, but we're looking closely at the PEG ratio right now, which is the PE ratio divided by earnings growth. It's basically a measure that tells you how much you're paying for future earnings growth. And we think that's absolutely critical here in a market that's continued to be dominated by risk taking and really ignoring a lot of the kind of noise that's going on in the background.
Emily, I keep thinking about the phrase you used, analysis paralysis. It was very relatable. And it kind of raises this question, if stocks are the ultimate forward discounting mechanism of what the future will bring, how do you extrapolate out some profit margin when the tariffs are still being negotiated and people are still debating what kind of ramification they will have both on growth as well as inflation?
Yeah. It's so difficult right now, Lisa, and I think everybody's trying to handicap the impact that tariffs may have to corporate profits. There are also some positive elements as far as the big, beautiful bill around CapEx expensing. That should be accretive to corporate profits. We're seeing deregulatory measures sort of playing out in the backdrop right now. So there's sort of competing forces happening that may impact profits from here. You know, right now, I think the biggest risk to markets is that there is no risk. You look at the forward PE ratio on the S&P 500, we're at around 22.5 times forward earnings. That's close to a 10-year high. We don't look at valuations as necessarily a catalyst, but the starting point's just really tricky because there's so much good news being baked in. I know you love to talk about a high yield bond spread. So do we. We're at 268-ish basis points over treasuries. That is close to 10-year tights. We're seeing Bitcoin at new all-time highs. So investors are saying that everything is awesome and there's not a lot of risks that are going to play out here. We think that that's probably a bit overly optimistic. So I think, again, gravitating to those higher quality stocks, selling into momentum. We're starting to see a little bit of weakness on the momentum side, maybe reallocating into lower volatility parts of the market, which looks like the value play right now, makes a lot of sense as some of these risks may materialize into the back half of the year.
And yet, Emily, people seem to be comfortable because they believe the Federal Reserve will start reducing interest rates and then go even harder in 26. Yet when I ask this question, and you might have heard me ask it through the week, is this an equity market that needs rate cuts? The bulls keep responding no. Do you think it is?
No, I mean, not right now. But what you'll see, I think you're exactly right. There's a honeymoon phase where if the Fed indicates that, yes, they're ready to start cutting, and we've, heard that from a couple FOMC members this week that, July was on the table. I think what you'll see is a positive reaction if the Fed is cutting just because inflation's coming down. Look, inflation's coming down. Of course, we get a big CPI report next week, but we're at the lowest level since 2021. There's significant disinflation coming from the housing side. I wish more people were talking about this right now. Supply of homes just jumped 30% year over year. We have the most homes on the market since 2020. Demand is slowing in the face of unaffordability, untenable insurance costs. People are worried about their jobs. Major shifts happening. Home prices are starting to roll over. Shelter is 35% of headline CPI. So I think there's enough disinflation on the shelter or housing side to potentially overcome any goods-driven tariff inflation that we see, again, on the goods side. So there's some dynamics that are happening under the surface that bond investors are not sniffing out, which is why we still think that there's a lot of value at 4.38 on the 10-year Treasury yield here.
You like 10s here. Emily, do you like 30s? Can I sell? Are you a buyer?
I don't think it's the worst thing. you can do. I mean, a 5% 30-year treasury, of course, you've got to right size that position because there's a lot of volatility there. But if you can lock in a 30-year yield around 5% and build that income stream, not the worst thing you could do in a portfolio.
We found one. There you go.
I was just about to say, you got a buyer. Good job. I'm impressed. You'll get a commission from the U.S. Treasury Department.
Emily Rowland of Manulife, John Hancock. Emily, thank you. Enjoyed this. Thank you very much. 30s this morning, 491, 10s, 438.
So close your eyes, buy everything, go to sleep, wake up in 2027 and figure it out then.
Disinflation argument was quite convincing, no? On the shouter side of things, at least.
If you take a look at pricing on a global scale, particularly in some of the areas in the United States that were most bid up in the direct aftermath of a pandemic, you have seen price decreases. And you've seen volumes come down. If rates stay high, well, that's a natural consequence because it costs more to borrow money, so people are going to negotiate harder when it comes to the actual price. I know that some people are closely connected with that story.
Trying to negotiate housing costs and stuff like that. Yeah. I've been trying to do that for years, Bramwell.
So you see it in real time. So maybe prices will go down and then it'll get a lot more attractive.
Not all of us got that 2-3% mortgage a few years ago.
Yeah, but the prices were high. That's the thing.
Yeah, all right.
Okay, whatever. But some of us
yeah,
really
so high.
Great.
Yeah, okay. Equity futures on the S&P. Let's get back to that. Far more comfortable with stocks. We're down about 0.6%. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Lizzie Burden. Hey, Lizzie.
Hey, John. Israel reportedly believes that some of Iran's underground stockpile of enriched uranium survived last month's attacks. The New York Times cites a senior Israeli official saying some of the material may still be accessible. The same official says that Israel had uncovered a secret Iranian project to build a bomb late last year. Elsewhere, Tesla's planning to expand its robo-taxi service into California and Arizona after its recent rollout in Texas. CEO Elon Musk expects the driverless cars could launch in the San Francisco Bay Area in a month or two. Tesla has also applied to operate in Phoenix, and a decision there is expected by the end of this month. And in sports, the women's singles final at Wimbledon will feature first-time major finalist American Amanda Anisimova after she upset top-ranked Arina Sabalenka in the semis. Anisimova will take on five-time major champion Iga Swiatek tomorrow. And in the men's tournament, American Taylor Fritz will play Carlos Alcaraz and Jannik Sinner faces Novak Djokovic. And that should be my brief. John.
Thank you very much, Lizzie. Yannick versus Novak. That's must-watch later, right?
How many hours do you think it's going to be? 8?
5, at least. I don't know.
What do they eat before that?
The stamina's unreal,
isn't it? Really? Is it just a massive thing of pasta? Do they have energy gels?
Speaking of tennis, did you see Bill Ackman this week?
Yes, I did.
Thoughts?
On one hand, I admire that he put himself out there.
Yeah.
That's all I'll say.
I'm going to say Andy Roddick came out swinging. So if you want to see some comments, have a listen to Andy Roddick. I'll just leave that out there. Up next on the programme, Trump presses forward.
The open question that maybe we're getting a little bit of an answer to is if you get enough resilience in economic data and the stock market trading at all-time highs, does that beholden the administration to sort of press forward with tariffs?
Up next, we'll catch up with Jeanette Lowe, strategist from New York City this morning. Good morning.
Technology is embedded in every aspect of our lives and laying the foundation for the future. From finance to defense, AI to entertainment, and from the road to the stars. Bloomberg brings you the latest stories from the people and companies pushing the tech sector to new frontiers and the politics that shape global tech markets. I'm Annabelle Drulers in Hong Kong. I'm Sherian in Tokyo. Watch Bloomberg Tech Asia. New episodes every month, only on Bloomberg Television.
So 2-day winning streak on the S&P coming into Friday, heading towards the weekend. We're down by 0.6% so far this morning, down by about 0.5% on the Nasdaq. Lisa talked about the underperformance in the Russell. The Russell 2000 this morning down around about 1%. Under surveillance this morning, Trump presses forward.
The open question that maybe we're getting a little bit of an answer to is if you get enough resilience in economic data, labor market data, you don't start to see a move higher with any, meaningful magnitude in the inflation data and the stock market trading at all-time highs. Does that beholden the administration to sort of press forward with tariffs?
It's the latest so far this morning. Stocks closing at record highs just yesterday as President Trump heightens his rhetoric on trade. The president threatened Canada with a new 35% tariff on goods and told NBC he's eyeing blanket tariffs of 15 to 20%. With those comments, equities retreating by about 0.5% so far this morning. On the latest, here's Tyler Kendall. Morning, Tyler.
Yeah, hey, John, good morning. Well, these recent moves really indicate that President Trump at the moment has no plans to retreat when it comes to his tariff plans. And our analysts at Bloomberg Economics crunched the numbers, and the average U.S. tariff rate is already up about 10.9 percentage points compared to when President Trump took office. It sits around 13.3%. So now imagine that with a higher baseline tariff rate between 15 and 20%, not to mention some of these individual country tariffs reaching up to 50% when it comes to President Trump's updated rate. Of course, another updated escalation that we got overnight was now a new threat of 35% against Canada. Importantly, a U.S. official does confirm to Bloomberg News that USMCA compliant goods are still expected to be exempt. That's going to be absolutely critical since the bulk of Canadian imports into the U.S. are typically USMCA compliant. Data shows us it's about 60% of the goods that come over the Canadian border. But still, this isn't going to be welcome news for the Canadian Prime Minister Mark Carney, who's tried to leverage his personal relationship with President Trump to negotiate. The thing is, with Canada, as well as a lot of our other trading partners, is that the White House wants a range of concessions. Look at the letter that President Trump sent to Canada last night. It talks about fentanyl concerns, also market access for U.S. dairy farmers. But we know just the other week, talks basically went off the rails because of the White House's dismay over Canada's plans to collect revenue from its digital services tax, which it ultimately had to abandon. John, just making this picture so much more complicated, of course, are those sector-specific tariffs, which is, of course, the latest update that we can just add to the list of updates from this week. Canada is one of the largest exporters when it comes to copper, no doubt complicating negotiations as everyone rushes towards that August 1st deadline.
Those levies still to come. Tyler, thank you. If you want some comfort, Kellyanne Shaw, earlier this week, former Trump trade negotiator, came on the program, sat around the table, walked in, and she just said, get a beer, take a break. It's going to be a messy few weeks because the president's going to start anchoring to the extreme. What have we had so far? Big tariff on Canada, more tariffs on the likes of copper, and elsewhere 15 to 20% blanket for anyone who's not managed to negotiate anything.
The difference this morning is the president is now pointing to the stock market, saying he's getting a green light to go further, or to even just keep it at some of the rates that he's been announcing in these letters. And everyone gets a letter, and this is what the letter says, and the market's digesting it okay. Does that raise the ante for how much actually gets through in the very end?
Here's the take from Jeanette Lowe of Strategas, a Baird company. Even if some of the tariff levels issued in Trump letters are designed to accelerate negotiations with some countries, not all countries will reach deals. Tariffs are going higher from here. Jeanette joins us now for more. Jeanette, welcome. I just want to build on Lisa's point. Do you think this record high in the equity market is a green light to keep pushing?
I think the important thing is that if you look back at what happened on Liberation Day, Trump put very aggressive tariffs on the table. We saw a sharp stock market reaction. And then you had the threats of there could be, shortages on the shelves and things of that nature, which then started to make the president walk that back. Now we have more fiscal policy. We have the tax bill, the One Big Beautiful Bill Act that has been enacted that provides some fiscal policy cushion, provides some relief to consumers and businesses with regard to the tariffs. And now we have a stronger stock market at this point. So the market isn't looking like it's as negatively impacted. So that does embolden the president to go forward and be more aggressive now. We're also not seeing inflation show up yet. But at some point, there may be start to see some increases in inflation in the CPI data or even in company profits. And that's something else that we're watching quite closely, is to see if there starts to be more economic pain that might show up. It might not be until closer to that August 1st deadline, but that then may make the administration try to rethink how these things get calibrated.
Jeanette, I want to pick up on something John was asking earlier. How much opposition is there to some of these policies from the Democratic Party, given the fact that, it's kind of a grand experiment. And if the economy doesn't roll over and the income from tariffs really offsets the deficit, who's going to really lobby against these?
Right. I mean, so I think one of the things that's going to be important is at some point, we do have inventories that were pulled forward ahead of some of these tariffs. The longer they're in, that's going to change the makeup of this picture. So the Democrats have an issue where, they've wanted to put into effect more restrictions on trade in some ways to help trade unions in the United States. Maybe not obviously to the extent that Trump is doing, but it does bring up the question of how do you then roll these back? I think there is definitely a difference when you saw the Biden administration able to keep the tariffs on China in place that Trump imposed, but that's much different than putting in, say, 20% tariffs on EU goods or 35% tariffs on Canadian goods. So there can start to be that pushback there. And you did see, obviously, earlier this year, Tim Kaine, senator from Virginia, put forward legislation to kind of walk these back. That did not pass, but that is something that they're probably going to push again. And if we do see more economic slowdown because of the tariffs, that could be something that then gets more traction later on.
We initially thought coming into this year that this would mostly be about China and the rest of the negotiations would be fairly easy. That, of course, has been significantly challenged. And now we have the potential for some sort of additional meeting between Chinese and U.S. delegates in the next couple of days. At the same time that the tariff rate on Canada seems to be similar to the one on China. How do you make sense of this? What's the ultimate goal when it comes to China?
Well, I think we do still have to keep a difference between what is happening with China and what is happening with the rest of the world. One of the things, obviously, Trump did say that the Canadian tariffs were based on fentanyl, but also other things, other market access issues, mentioned dairy in the letter. We have actually seen more fentanyl coming across the border if you look at the most recent customs data. So that could have been an impetus for this. The digital services tax was also an irk for the Trump administration that they wanted to get taken away. But I think that they're ultimately, if we still have this carve out for goods that are USMCA compliant, that is significant. I think there's going to probably be a push to get more goods to fit that USMCA compliance setting so that they would be able to enter the U.S. tariff free. But there's definitely still a difference with China. If you look at China, we still have tariffs from Trump's first term. Those were never removed. Those were kept in place by Biden. They were actually increased. Trump has now increased them even further. And if you look at a lot of the trade deals or the discussions that have been occurring with the administration and other countries, it's also about country of origin. Is China putting goods into Vietnam that then get shipped to the United States? That is something that the White House would like to stop. So we still think that there is a much more aggressive tone towards trade with China and trying to get production out of China and into other countries or back to the United States. And that is still going to be a difference going forward, regardless of the talks that may happen.
Jeanette Lowe, a Strategas, a bad company. Jeanette, thank you. That last point is so important. We talked about this quite a few times on this programme. Democrats complained about the president's tariffs in his first term, kept them. In some places, put them up. That's going to be the test in the next general, because what you're also going to see this time is some real tariff revenue. If these levels stay, it's going to be hard to campaign against that.
Especially if that means raising taxes on the other side or else having a larger than expected deficit. This is the conundrum that the next election will be debating about.
Years away.
Yes, exactly.
Don't have to think about that right now.
1.5 years.
Up next on the programme, Erica Najarian of UBS as JP Morgan CEO Jamie Dimon warns markets are too complacent, plus Yahira with your morning movers and a downgrade for a top name in the copper industry. Through Thursday, coming into Friday, so as of the close just yesterday, stocks and bonds almost totally unchanged. Yields on a 2-year, unchanged. 10-year, unchanged. This equity market basically unchanged, positive 0.02%. This morning pulling back by 0.5% on the S&P, by 0.5% on the Nasdaq. This week was a good week to take a vacation. In the bond market, it is interesting. Nevertheless, let's split this up in two, the front end and the long end. Some comfort this week at the long end of the curve. Brought to you by two auctions, 10-year and 30-year supply went okay. So let's move on. Front end of the curve. I'm not saying we won't talk about it the rest of the year, we will. At the front end of the curve, a big debate starting to emerge. All of a sudden, I think we are talking about real dissent in July. There were some people who saw the FOMC minutes early this week and said they were dated because we just had the jobs data, which would make it difficult for the likes of Governor Waller to make an argument for a rate cut at the July meeting. Governor Waller came out yesterday and essentially told you there's a decent argument for a July rate cut.
And a lot of people in the market agree with him. And I think this is important, even as he pushes back and says, look, this is not political. We are seeing disinflation around the margins. There are people in the markets, including in BlackRock's David Rogel. came out with the FOMC meeting minutes and said that easily they could see a July rate cut simply because the inflation data has been relatively benign and there are signs of a slowing in the labor market. This isn't necessarily political, but it's going to be framed in a very political way.
Bond yields this morning are higher on a 30-year, up by 4 or 5 basis points, 491. We'll never move on. Highest yields on a 30-year, going back to 2011 in Europe, in France, in Germany. European story still brewing. 2 hours away from the cash open in the equity market. Let's get you some morning movers. Let's cross over to Yahira. Hey, Yahira.
Hi, John. Any wavering you're seeing in the equity market is not showing up in crypto. Take a look at these crypto-linked stocks. Coinbase, MicroStrategy, Mara Holdings, and Bit Digital are all rising after Bitcoin surged to new highs, now topping $118,000. What a run. Next up, we have Freeport-McMoRan. The stock is down 2.25%. I've mentioned the American mining giant a lot this week. That's because it was thought that it would stand to benefit from President Trump's 50% tariffs on copper imports. But UBS just gave it a downgrade. It is now down to neutral. Analysts there saying that they expect a softening in demand and fundamentals to weigh on copper prices over the next 6 months. So throwing a bit of cold water on the optimism there. And we end with SoFi Technologies. The stock is down about 1% after TD Cowen started coverage on the stock, giving it a hold rating and saying that the stock looks fairly valued from here. But this stock has had quite the run. It is up nearly 40% in the past month as investors caught wind of potential policy changes coming to student loans that could funnel billions of dollars to private lenders like SoFi. John?
Yahira, thank you. More from Yahira in the next hour. At a rate hour this morning, President Donald Trump threatening a 35% tariff on some Canadian goods. The announcement coming after he told NBC News he's eyeing blanket tariffs of 15 to 20% on many trading partners.
I keep going back to my big question. Is this stock market pricing these tariffs in and saying it's okay because the stock market is not the economy and it's a lot of big tech stocks that are relatively immune? Or is this stock market betting that the president's going to back down? And if it's the latter, then how much does it set up a big game of chicken between the president and the markets where there is a clearing point and we could reach that at some point in the next few months?
Or it's fair to say it's a bit of both. It certainly feels that way at the moment, doesn't it?
So what is this, real-time calibration? The president, 13%, the market's fine. 15%, the market sells off. Is he trying to figure out kind of what the economy can absorb by looking at the market?
It's fairly well understood this is a negotiation. So there is a belief that whatever the threats are now, they will be lower. Higher than the start of the year, but lower than the current threats. So that's that little bit of the trade story not fully following through. The second piece of it is the earnings are okay and they take some comfort from that at the moment, and the data is just about holding up.
Yeah, and just to build on that, who's he negotiating with? The trading partners of the stock market, corporate executives. And I think that we're going to see that come clear. I'm still struck by the fact that Vietnam was unaware of the 20% rate that they supposedly agreed to that was then announced. A lot of unknown, and I think people are clinging to the here and now, which is the reason why earnings will be so important.
Certainly the all-time high has given him some confidence through the next 3 weeks.
Yeah, maybe rightly so.
That's for sure. A key Trump administration official saying Fed Chair Jay Powell has mismanaged the central bank. The director of the OMB writing in a letter to Powell, quote, "The president is extremely troubled by your management." This pressure is coming from all sides on this Fed chair.
And this tends to be the president's tactic, right? It's sort of look for all of the ways to ramp up pressure, either related to monetary policy or not, to try to jawbone into a position that seems like it's more amenable to the White House. I just wonder if the president isn't looking to lose Powell, to fire him, is he looking for him to step down? Is he looking to scapegoat him if there is any faltering in the economy? Is he looking just to make them some sort of poster child of the debt problem and the deficit? He kept talking about this, and I think Jim Bianco really raised a good point. President Trump seems to see the U.S. rate structure as being a credit one, not a sovereign one, and keeps saying that rates should be lower because of the creditworthiness of the United States. Whereas sovereign rates typically are tied to growth and inflation, which is a completely different calculation. And that tension, I think, is really there.
In some ways, it's needless drama, because for most people, they think this Fed will be exactly where the president wants them to be in September, and they'll start cutting interest rates. And that's only 2 meetings away. For the chairman of the Federal Reserve, he's obviously in a tough spot. He has pledged to anchor inflation expectations first and foremost, and he believes that's his most important job. A lot of people might agree with that view. The pressure that's coming, though, from the White House, and I've heard this argument made so many times, makes it harder optically for Fed Chair to transition beyond his current message. In some ways, it makes it harder for him to reduce interest rates. And I think the president deep down knows that because we've seen him ultimately say as much in public.
Which means maybe he wants him to hold rates where they are. I don't know. It's the reason why Chris Waller has to come out yesterday and say, look, this isn't political. For him to even have to say that raises a lot of questions for people. Okay, thou who protesteth too much, right? There is this sort of undercurrent of questioning of the validity of this institution. And I think some people are very concerned about
I think
that.
we as journalists have a role to play here to cut through some of the noise. Not all arguments for lower rates are political. That the argument that Governor Waller has presented is an economic one that we've heard from economists on Wall Street as well. There are credible economic arguments to lower interest rates right now, just as there are, going to sound like that two-handed economist sitting on the fence, but just as there are credible economic arguments not to. And that's a worthy debate that's taking place on the FOMC. I, for one, am happy there's at least a debate taking place on the Federal Reserve. I like to see that division instead of the groupthink that has really dominated that institution for quite a while.
I welcome it as well. I don't welcome the sort of questioning of the integrity of an institution. I mean, look, you can do that. I just think that that might undermine their ability to really monitor the inflation with
to do the right thing.
To do the right thing. And I think that is the one real question here. You know, are people going to be reluctant to cut rates because of the political pressure, sort of ironically? That's a real concern.
Unless they're political and they're running for that seat. But yeah, OK, let's move on to this.
Analysis paralysis.
I know. Nvidia CEO Jensen Huang met with President Trump at the White House just yesterday. Sources telling us here at Bloomberg the meeting came just days before Huang is travelling to, guess where? To China.
Yeah, and he's going to be talking about the importance to really free up some of the chip sales and how an integrated ecosystem across countries is actually better for the AI development. Let's see how this goes. We don't know what he's going to talk about. Nonetheless, it's sort of who's got the preference in the C-suite of the White House. Right now, Jensen Huang seems to have the front seat, so let's see what he does with it.
Ed Ludlow, who led some of the reporting here, is going to join us in about 30, 40 minutes. We'll catch up with him a little bit later in the programme. Let's turn to the banks. The JP Morgan boss, the CEO, Jamie Dimon, warning markets are, quote, complacent on President Trump's tariff plans. His comments coming ahead of bank earnings season kicking off just next week. Looking ahead to those numbers, Erica Najarian of UBS. Erica, welcome to the programme. We've heard Jamie Dimon, Mr. Dimon, talk about clouds on the horizon, storm clouds, and then earnings come along and it's blue clouds and sunshine. Do you expect anything different next week?
No. Actually, it's not only the clouds are not just breaking in the second quarter in terms of the results, but it looks like blue sky as we think about the second half of the year. So think about it this way. There was really a pause in activity, whether it was loan growth or capital markets, in all of April and maybe into the first 2 weeks of May. And then what you're seeing in the regulatory data right now for loan growth and what you're seeing in industry data for investment banking is that June was a super solid month. In fact, we haven't quite had this start in first half loan growth in some time. And so you're going to have a pretty decent result. And you're going to talk about strong pipelines in the second half of the year. And by the way, what else happened in June? You had a stress test that unlocked, on average, 90 basis points more of excess capital. And so, look, Jamie's Jamie, and he's always going to be cautious and warning us of the tail risks. But I think the clouds have broken in the second quarter, and you are seeing blue skies for the second half.
Blue skies, and did I call them blue clouds? I might have done.
It's okay. It's Friday.
Blue skies.
Are you kidding? I can
I'm
barely
with you.
speak.
I'm struggling.
So carry on.
Lucky we've got Erica with us. Erica, I'm picking out the numbers from your report. The rally we had off the low on the KPW Bank Index of more than 38% so far, close to 40%. Erica, just how much of that story that you described for the second half, the so-called blue skies, how much of that have we discounted so far?
Look, what we essentially clawed back in that rally is taking the tail risks off the table in terms of tariff policy. I listen to you and Lisa, talk about your views. Who knows, right? But I think what the market is saying is, I think that risk, whatever that was in terms of the low, April 4th, that we were pricing in is now off the table. What may still have, legs in terms of continuation of the rally is the fact that deregulation is just so much more powerful, so much faster under Trump 2.0 than under Trump 1.0. I mean, we essentially had to wait 21 months after inauguration in Trump 1.0 to get our first regulatory proposal. We had a stress test proposal in April before Michelle Bowman, the vice chair of supervision, was even confirmed. And so we have, a pipeline of proposals that have already happened, whether it's stress test or the supplementary leverage ratio or SLR. And then we have more to come in terms of a more comprehensive stress test reform, G-SIB recalibration. And, we said something, 100 basis points of, lower capital minimum is something like 150 basis points of extra ROE. So I think that's why, you can continue to see the rally in the banks.
Is this ultimately then a regulatory story, or are we going to see outperformers that we had been expecting heading into this year? And I'm thinking about mergers and acquisitions or IPOs in the investment banking space.
Yeah, I think it's going to be both a deregulatory and activity story. And thus, we also said in a report, you may see a broadening of the rally to scope regional banks who have woefully underperformed the money center banks really since election day. And so, I think what you'll see is the broadening of the bank rally, because you will hear about these M&A pipelines getting better. And look, these regional banks not only benefit from that in terms of some of the small boutique investment banks that they have within their companies, but also what that could mean for loan growth going forward.
Erica, looking forward to bank earnings season, and hopefully we can catch up next week. Thanks for dropping by. Erica Najarin there of UBS, looking ahead to financial earnings about a week away. Blue skies and sunshine. Got that right this time.
Perfect.
For bank earnings next week.
They've got the deregulatory tailwind. They have investment banking activity that's been picking up, trading activity that's been robust, even if it's a trading environment that goes to nowhere. And then, of course, there's a steeper yield curve, which also benefits them. So there are a couple of different prongs that are all firing. So despite some of the pretty dire commentary from Jamie Dimon, expect the profits not to reflect that.
A close to 40% rally off the lows on a KPW bank index from the lows of April. Unreal. Futures this morning pulling back a touch from all-time highs. We're down by 0.5% with an update on stories elsewhere. With your Bloomberg Brief, here's Lizzie Burden. Hey, Lizzie.
Hey, John. Secretary of State Marco Rubio met his Chinese counterparts on the sidelines of the ASEAN talks in Malaysia. It's the first in-person meeting between the two since President Trump returned to the White House. After the meeting, Rubio told reporters odds are high for a meeting between President Trump and China's Xi Jinping. Elsewhere, New York City Mayor Eric Adams raised more than $1 million in his re-election effort in a single night in a fundraiser in Manhattan. It's a stark turnaround for Adams, who in March reported raising just over $18,000 in a 2-month period. In recent weeks, his campaign's been boosted by donors and business leaders opposed to the Democratic nominee, Zohran Mamdani. And the original Hermes Birkin bag sold for a record $10 million at an auction in Paris. The 40-year-old black leather handbag sold after a bidding war that lasted more than 10 minutes. Tokyo-based designer goods reseller Valuance Japan bought the bag and said that it will exhibit it as a piece of, quote, global cultural heritage. And that's Bloomberg Brief, John.
Lizzie, thank you. More from Lizzie in 30 minutes' time. Keep it together, Bramo.
Well, I mean, first of all, two things. That's where AMH is, clearly, to bid on the Birkin
I was
bag.
missing her.
Yeah, exactly.
I need the take from Anne-Marie.
And then the second thing, and this was pointed out by Chris in the control room, is sort of the Mamdani and then the Birkin bag is fantastic. Yeah. It's sort of this wonderful contrast of 2025.
Is that what he's campaigning on later on this year?
The $10 million Birkin bag.
Some people have got too much money.
Yeah, well, that seems to be his take, but there shouldn't be any billionaires, right?
So I hear. Up next on the programme, a tale of two consumers.
If we look at other categories, discretionary categories like restaurants, you're seeing fewer, but some households pull back completely. But the people who are still going out to eat are going out more often. You've got a little bit of a disconnect, and it's kind of a tale of two cities.
Up next on the programme, we'll catch up with Stephanie Roth of Wolf Research, live from New York. You're watching Bloomberg TV. Slow grind towards the weekend, almost there. Equity futures down about 0.5% on the S&P. Little change so far this week, coming into Friday at all-time highs. Just a small pullback so far, down by 0.5 on the Nasdaq 100. Also, under surveillance this morning, it's a tale of two consumers.
There are certain households, lower-income households, who are pulling back completely from making purchases in travel. If we look at other categories, discretionary categories like restaurants, on the other hand, again, same analysis. You're seeing fewer, but some households pull back completely. But the people who are still going out to eat are going out more often. You've got a little bit of a disconnect, and it's kind of a tale of two cities.
So here's the latest. Mixed messages for the consumer coming from two corporations. Delta Airlines restoring guidance, saying travelers are coming back. Meanwhile, Amazon seeing a plunge in Prime Day sales compared to last year. To discuss, Stephanie Roth of Wolfe Research. Stephanie, good morning.
Good morning.
Who's got it right? Is it terrible or great? Is it Amazon or Delta?
It's always somewhere in the middle. So I think what we're seeing is services were hurt in the first half of the year, largely driven by concerns around the economic outlook. A lot of that's super discretionary. So people pulled back there, especially when it came to travel. That's going to start stabilizing through the back half of this year. And then people pulled forward their demand for goods because they were concerned about tariffs. So now we're going to have the reversal of that, where the services side of the economy gets a little bit better, and there's a little bit of an air pocket on the goods front.
There's a much more simplistic way of explaining what John just said, which is people are buying $10 million Birkin bags and then they're voting for socialist policies because you have the tale of two consumers, right? I mean, kind of what we were discussing before. Is that overly simplistic, or do you see that gap widening in terms of the ability of consumers to keep spending on the lower income side as well as the higher income side?
Yeah, I think that gap will persist. I don't think it's necessarily going to get materially worse. Of course, at the very low end, they are certainly hurt by tariffs more so than other folks. But we'll see the low-end consumer continue to remain, fairly sluggish, but the rest of the economy should be okay. And it's going to largely depend on the labor market. To the extent that the labor market remains okay, we don't see layoffs picking up materially, then the consumer should spend, albeit at a fairly slowish pace, somewhere around 1.5%.
So just to extrapolate this a little further and get a little bit existential, because it's Friday. It's Existential Friday. There's been this sort of overlay of a theme where white-collar jobs have been disappearing, and there are fewer of them and they're higher paid. And blue-collar jobs are actually expanding. And people are able to get blue-collar jobs because there are immigrants who are leaving the country or who aren't coming in as quickly, and because there is a much bigger demand for that. Are we actually seeing that in any of the economic data that will actually boost the lower and middle income end and will actually give some sort of tailwind, frankly, to a lot of the consumer-facing companies?
Yeah, I think that's a really good point. And the latest jobs print might have been the first indication of that. We saw downward pressure on the unemployment rate. Yes, the driver between native-born versus foreign-born is not entirely clear, but I think what we're starting to see is that there's some funky things under the surface that's really putting downward pressure on the unemployment rate as a result of this reduction in immigration. That's going to put upward pressure on wages for blue-collar workers, which could start to help that feed through the data. Granted, a lot of the major changes on immigration only happened at the end of May. So we're really just starting to see the effects of that, and it should take throughout the course of the summer, perhaps into Q3, to become more abundantly clear.
You've referred to three different sources of inflation through this conversation so far: goods, services, and labour. How is CPI next week going to capture that story?
Yeah, so I think we're going to start to see inflation creep up a bit. We're looking for 0.26 on core. June should be kind of modest compared to the next couple of prints that we're going to get. And it's important to flag that financial services should also be a big source of upward pressure. So that's one thing we didn't even talk about. But that's been pulling downward pressure on core PCE in the last couple of prints. It's very much going to reverse on the back of strength in equity markets. So what we're looking at is a string of core PCE of 0.3% or above for the next couple of prints, which makes September a really difficult backdrop for the Fed to be cutting.
So you think it's hard for the Fed to cut in September, at a time when the likes of Governor Waller's going around saying, hand up, let's go, might have to cut rates as soon as the next couple of weeks?
He's also saying, hand up, I'll take the job as Fed chair. So there's some
You think it's political? When he sits there and says it's not political, you think it is?
Yeah, I think he's vying for the chair job. He doesn't seem to be towards the top of the list, but I think he would be a good candidate for it. But I think he's trying to get the job. I think that's the main message there. The Fed does want to cut. They are looking for an opportunity to cut a couple more times. I just don't think that the data are going to be consistent with that by September.
One of the reasons why there is a legitimate economic argument that we've been hearing to be cutting rates sooner than later is because there are sources of disinflation, and we are seeing that, and housing prices is one of them that we keep pointing to. Why is that not fair, given that it's about a third of CPI?
Yeah, but it tends to move fairly slowly. It's going to continue to kind of ratchet down. And in this print in particular, we actually think, just given the volatility in owner's equivalent rent, we actually think it could bounce back a little bit, at least just temporarily. But the rest of the inflation metrics are going to be moving the other direction. So sure, housing could be decelerating, but when you get goods prices picking up, travel starting to rebound a little bit, that's just a tough backdrop for the next couple of prints.
Bank of America's Michael Hartnett came out earlier this morning and said, when we look back, the 2020s are going to be an inflationary decade that reverse a lot of what we had seen over the past 4 decades of disinflation. Do you think that the evidence has borne that out, or do you think the jury is still out to really understand how this is all going to shake out, what the ramifications from supply chain disruptions from the pandemic will be, and how much tariffs will really rejigger that?
No, I think this is just a fairly temporary second inflation shock, and we're going to be looking in a year and a half time. We're going to be moving back down towards 2% on inflation, and this will not really be a big issue. Granted, for the next couple of months, it's just difficult for the Fed to cut, just because there are temporary inflation upward pressure.
So you think Governor Waller does have a credible argument here for lower rates? The one he's articulating, you think he might be running, okay, that's your opinion, but ultimately underpinning that is a credible argument for lower interest rates.
There's a credible argument for lower interest rates. I think now is tough to sort of rush into it, just given inflation should be elevated for the next couple months. And there's not a rush. The economy's okay, and it's proved to be not that interest rate sensitive. So there's not that much harm in waiting a couple of months until we just see where inflation ultimately settles.
I still remember when Bill Dudley came out years and years ago and said Fed funds might have to go through 5%. And everyone said 5%, good luck. This economy will crater. Didn't happen.
And part of that is because a lot of people had already extended out a lot of their personal maturities. How much it really will be stimulative if they do cut. You could say on one hand, it's not a big problem. You can wait, but you could also afford to cut then, especially if it's politically expedient.
Just before you go, just quickly, when's the first cut? What month have you got penciled in on the calendar?
I think we're talking mid-2026.
You think the first cut is mid-26?
Yeah, because I think we're going to see inflation a little bit elevated here. Then growth is going to remain pretty strong. We're going to have positive stimulus from the fiscal bill, and it's going to be just a tough backdrop for them to cut. Eventually they will. They certainly want to, and it makes perfect sense for them to get there. It's just going to take some time.
And we'll have a new Fed chair in the middle of 2026.
You know who agrees with her? Bill Dudley, the person who thought that there'd be 5% interest rates.
Stephanie, it's good to see you. Thanks for
you.
dropping by. Stephanie Roth there of Wolf Research. Coming up next, Jose Minaya of BNY, Angelo Zeno of CFRA, Steve Rasciuto of Mizuho, Walter Piecyk of Lightshed Partners calling for a change at the top of Apple. That conversation in the next hour.
What started out as just a relief rally is starting to become something real.
The markets are adjusting. There's no panic so far.
If you're looking at what's been working in markets the last couple of years, it's quality stocks.
The market is pricing in a friendly sort of mix of growth, inflation, and policy.
Equities and risk are discounting the here and now.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. The third hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P pulling back from record highs. We're down by 0.5%. Similar move on the Nasdaq 100, down by 0.5. The Russell this morning down by 0.9. As we work our way into the weekend, look ahead to next week. Fireworks, CPI, Tuesday, alongside earnings from JP Morgan, Wells Fargo, and Citi.
Yeah, the earnings to me really are front and center. CPI, of course, we're going to be looking for any type of tariff ramifications coming through that tariff-related inflation or not. The earnings that will give maybe the better picture. Do we see a repeat of things are stable, a la Ed Bastian over at Delta, or do we see beginnings of a sign that there's some sort of hit to the economy? If we don't see that, which is what's widely expected, how much more can this market rally?
Erica Najarian of UBS said blue skies and sunshine for the financials next week after a rally of almost 40% off the April low. Let's go with Jamie Dimon. Let's think about Ed Bastian. Ed Bastian of Delta is making the argument that businesses now have more certainty than they did in the first quarter.
And part of that stems from the one big beautiful bill. I mean, this to me is the certainty that a lot of people are looking at to give a sense of the tax planning, of what kind of investment they could potentially do. Key question will be, does it give them the stability to make large investments that might hinge on supply chains. And that, I think, might be something that some of the bank executives could answer.
Yeah, compare that to Diamond, who's talked about businesses sitting on their hands. Are they still sitting on their hands? Or do we see that pickup in activity in the second half that many of the bank bulls think we will see?
And this is what we've seen with respect to recent acquisitions, even with Kellogg, for example, the Nutella and Fruit Loops. I keep thinking about that and thinking, why would anybody do that? But going forward, how much more can we see of certain companies that see a benefit of being larger and could see enough of some of the noise dissipating to really have that conviction and make those investments?
A fantastic lineup of guests so far this morning, including the conversation we had about 5-10 minutes ago. Stephanie Roth of Wolfe Research, making a case for the first interest rate cut to come in the middle of next year, 2026, and looking for firmer inflation reports going into a tricky September meeting. I don't think that's what this market and many people are looking for going into next year.
You know, this goes to the question, and you've been asking it all morning, and rightly so, how much does this equity market depend on rate cuts? And what we've heard from the bulls is it doesn't at all. And it actually can continue with the gains regardless of any kind of rate cuts. A number of people have said that's not true. You need the disinflation to continue in order to support the rest of the environment. But ultimately, that's the question. Is Stephanie's view prohibitive to further gains on the equity market, or is it supportive because the stability in the economy is what will actually keep driving the equity market higher?
Equity so far this morning, negative by 0.5%. Coming up this hour, Jose Minaya of BNY on investing in a volatile environment, Steve Rasciuto of Mizuho on a shock-proof economy, and Walter Piecyk of Lightshed Partners calling for disruptive change at Apple. That is must-watch later this hour. We begin this hour with stocks lower as President Donald Trump floats a higher global tariff rate. Jose Minaya of BNY Investments and Wealth writing this: volatility is here to stay invested, and look for the right diversification.
नहीं क्रूड ऑयल नहीं, कोई न्यूज़ नहीं है क्रूड ऑयल में प्रॉफिट बुक कर लेना सेलर्स जिन लोगों ने सेल किया था क्रूड ऑयल में, बुक द प्रॉफिट, ट्रेल मत करना यहाँ पर, ठीक है। बुक द फुल प्रॉफिट इन क्रूड ऑयल एंड नेचुरल गैस में सेलिंग में जो लोग थे वो भी निकल गए होंगे। ये बाइंग का एक छोटा सा ट्रेड लगाया था, उसका भी हो गया टारगेट। बुक द प्रॉफिट इन नेचुरल गैस बाइंग ट्रेड एज वेल। क्रूड में अभी बाई मत करना, ठीक है। 7 बजे की कैंडल है, थोड़ा सा वेट करेंगे। सपोर्ट जरूर है पर डायरेक्टली बाई नहीं कर सकते। 7 PM की कैंडल, यूएस मार्केट इज गोइंग टू ओपन हो गया तो थोड़ा सा वेट करा जाएगा। बाकी जो सेलिंग में है बुक द प्रॉफिट। एक नेक्स्ट ट्रेड देखते हैं कुछ और बनता है यहाँ पर। अगर अच्छा फॉल आ गया है, ठीक है, 120 पॉइंट। डायरेक्टली बाय मत करना, ठीक है। क्रूड में वेट करना, 7 PM की कैंडल है।
But it's more about what are the solutions you're looking for. You're seeing more and more of that in the industry, whether it's technology with kind of SMA capabilities, what you're doing with model portfolios, which we do in BNY Advisors. Across the board, it is about staying invested through these times, but kind of understanding what outcomes you're looking to get.
Well, let's run with that. Stay invested, long-term time horizon. Got it. What are these strategic anchors you're offering people to get them comfortable with doing just that?
Well, I think, again, it depends on their needs and outcomes. In some cases, it might be, hey, they're looking for income, right? Like, we create a lot of like what we call like, you know, bond portfolio in a box or personal bond portfolios with our Insight investment platform, where it's like we're getting very customized in how we deal with our clients. It might depend on when are you looking to retire. Is there a wedding? Is there educational needs and these things? So you might need principal protection. I've got a new niece on the way. In that case, I'd be like, hey, you should just go long equities. So again, we could spend a lot of time thinking about the noise, the volatilities out there. If you look at it, hasn't paid off to just say I'm going to stay off the markets. And there's still a lot of cash out there. But again, that idea of I'm going to stay invested, but am I really focused on my solutions and my outcomes versus call it a 60-40 type of portfolio?
Congratulations on your incoming niece and going all equities in response. I am
for
curious,
her,
though,
for her, yeah.
but for her, for the niece, not necessarily the parents. But I am curious about how much going forward the ballast for income comes from the same place. You said not necessarily a 60-40 portfolio. Let's say someone is conservative and looking for income. Does it still come from U.S. Treasuries? Does it still come from credit? Or do you have to look elsewhere for that type of ballast?
No, I think the markets are becoming a lot more efficient and they are looking elsewhere across the board. Again, we've seen the advent of private credit. It kind of plays a big part of this. You saw with the Secure Income Act where now annuities and guaranteed income contracts are being allowed to be used in 401k portfolios. think these are all important legislations that are all kind of recognizing the incredible crisis we have from a retirement perspective, not just globally, but definitely in this country. So you need to kind of look more broadly.
There's a little bit of skepticism in younger generations, it seems. There's this concern that maybe the same kind of gains that the older generation saw in their portfolios are not going to subsist in their generation. Do you think that it will? Do you think that the returns will be the same in the next 10 years that it has been for the past 30 years for a generation that has gotten wealthy off stock market returns?
I don't. And what I mean by that is, if you look back over the last 20 years, you would have been, for all this discussion around different investments, hedge funds, private equity, at the end of the day, you would have been just fine doing a very low fee, kind of like passive equity funding. You would have been just fine. I don't think that's the case in the next 10 to 20 years. There's just a lot more volatility. There's a lot more volatility out there. I think returns are going to be more measured, yet it's, again, finding your spots. Again, it's not about anymore, can I find the strategy that just I can sit back and it's just going to grow 15, 20%. It's being able to do the work around how you diversify your portfolio.
I applaud the risk appetite of the younger generation, looking at things like crypto, don't you?
Well, where else are you going to get
Their risk appetite is far higher than it was when we were growing up.
But maybe not necessarily for the same instruments. And this is exactly where I was going to go. It's for Bitcoin. It's for hedge funds. It's for NFTs. It's not necessarily for some of these other instruments. And are they correct?
Yeah, I would actually, slightly disagree, John, a little bit, that I think if you look at the younger generation, they tend to be a lot more risk averse in terms of buying a home. They're buying their first home.
Well, that's an affordability issue.
Affordability.
They just can't afford it.
Yeah, but I have conversations with some of these folks, including in my family, where, they're heavy in cash. But if you look at their portfolio, what they're invested in, they are invested in crypto or these things. So there's a lean here to technology and some of these quote unquote cool things versus, look, just put your money in a 401k and max it out. Hey, by the way, do a balanced portfolio, set it and forget it. That stuff, I think there's a lot more risk aversion.
Can we get your ideas on what to do with bonds? This is what Michael Hartnett of Bank of America had to say this morning. Best performer decade to date, gold. Worst, treasuries. Calls it a decade of inflation. What should you do for the decade ahead, and what do you do with that bond portfolio? You talked about income. A lot of people are very worried about inflation hanging around for too long.
Yeah, look, I think we've got a more kind of constructive view on inflation. It's why we still see the markets kind of maybe topping out, or the wide end for us is around 6,400 S&P. But look, I think this is a time where there's likely to be more rate cuts coming, right? You can debate whether that matters or not. You were just having that conversation. I think it's a good time to lock in yields today. And again, for us, it's not necessarily just about what's going on with treasuries, right? It's again, how are you looking at your overall platform and portfolio? There's a lot of different kind of characteristics to take into account.
Jose, I appreciate your time.
Thank you.
Thanks for giving it to us. Thank you. Jose Minaya there of BNY. Similar argument on income from Emily Rowland a little bit earlier this morning.
There's value there. And actually, it will serve a similar, not necessarily the same kind of role that it has played in the past, but it will still provide income. And that's the reason why people have been going into credit. That's the reason why people have been going into treasuries. You're actually getting something for them. So why don't you get them now, even after some of the biggest consecutive losses that we've seen in a generation?
Even with credit spreads super tight. How many times do we hear the same argument?
And it's what's borne out this year in the market. I mean, let's just call it what it is. It's actually been the ongoing grinding tighter in that spread picture, despite some of the naysayers.
Credit spreads are near the tights of the year. Equities coming into Friday, all-time highs. Check out the Treasury market this morning. Yields higher by 4 basis points so far. The 30-year at 4.91. The 10-year at about 4.38. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Lizzie Burden. Hey, Lizzie.
Hey, John. President Trump is threatening a 35% tariff on some Canadian goods. The tariff is an increase from the current 25% tariff level and would take effect on August 1st. It'd be imposed on US imports from Canada that aren't shipped under the terms of the US-Mexico-Canada agreement. Trump also told NBC News that he's eyeing blanket tariffs of 15 to 20% on most trading partners. And President Trump plans to visit Texas Hill Country today, where at least 120 people were killed in last week's flash floods and more than 170 are still missing. President Trump is expected to get an aerial tour of some of the hard-hit areas and met with first responders and relatives of flood victims. And Apple is planning a release of a line of new products during the first half of next year, including a new low-end iPhone, multiple iPads and upgraded Macs. The budget smartphone, dubbed the iPhone 17e, will be a follow-up to a $599 model that Apple launched earlier this year. And that should be my beast, John.
Hey, Lizzie, thank you. More from Lizzie in about 30 minutes' time. Up next, the Morning Calls Plus, Bloomberg's Ed Ludlow and Angelo Zeno of CFRA as Nvidia's Jensen Huang takes a visit to the White House. Live from New York, you're watching Bloomberg TV.
This is going to be the core of the debate as we get into the second half is there room for the Fed to cut much more aggressively in the event that the economy slows, this tariffs inflation story turns out to be transitory, or will they have to remain on hold for the entirety of the year to fight off an economy that's starting to overheat?
Ed Al-Husseini of Columbia Threadneedle making the argument the second half of this year could be tricky for this Federal Reserve. Stephanie Roth of Wolfe Research making the argument that you might not see rate cuts until the middle of next year. From New York City this morning, good morning. Equity futures so far negative by 0.5% on the S&P. On the Nasdaq, we're down by 0.4%. That's the price action. Here's some morning calls. First up, Piper Sandler raising its price target on Amazon to $250, citing the Prime Day sales doubling in length to 4 days. Bouncing back on that stock by 0.75%. Your second call from Wedbush upgrading Cinemark to outperform, saying the company is poised to benefit from a consistent slate of movie releases. That stock is up by 2.5%. And finally, TD Cowen upgrading Texas Instruments to buy, saying the chip maker is positioned to outperform in either a sharp or gradual recovery. That stock is up by 0.5% also. Let's stick with tech. Nvidia CEO Jensen Huang meeting with President Donald Trump at the White House yesterday. Sources telling us here at Bloomberg that Huang is set to travel to China in the coming days. Helping to lead our reporting, Bloomberg's Ed Ludlow, and he joins us now for more. Ed, what was the purpose of that meeting?
Well, it's interesting because we don't know what they discussed, although the president took to social media right to talk about the growth in Nvidia shares and the $4 trillion milestone. What was interesting is earlier this week, Jensen Huang went on MSNBC, and in the course of that interview, he made the argument that the American technology stack, in which Nvidia currently holds a monopoly in the market for AI chips, is akin to the US dollar, right? The US dollar is the world's reserve currency. And the message that he was kind of putting out was, you know, we want our technology to be the world's technology reserve, and therefore China needs to have access to it. And he's kind of been consistent on that, John. It's not a matter of tariffs or penalties. It's an issue of export control. And he has basically consistently said 50% of the research and researchers focused on AI are from or in China. And it's better they have our tech than their own tech if we want to stay in control of this field.
Ed, any sign whatsoever that argument is actually resonating with this White House?
So there's reports that Nvidia has decided to proceed with a specific designed for China chip that may come in September. The situation was that they required a license for their existing China chip. They decided not to pursue that license. And what Jensen Huang told me, if you remember, is you can't engineer any more performance out of these things unless you start from the ground up. Nvidia has not officially confirmed that. Jensen Huang regularly goes to China. They have many employees in China, but it is notable, our reporting, that he's going to meet with the Commerce Ministry. And, one would imagine, and based on a lot of the conversations I've had with big investors as well, that Jensen is very fixed on this idea that they're an American company that conforms with American laws. I'd suggest that in that conversation with the president, he would say that, but also knows he has to go to China and get something out of it. Reassure customers that basically have had their access to that technology cut off.
Just before you go, one final question, different company, similar theme, Apple. This came from Lightshed's Walter Piecyk. He's going to join us later this hour. AI will reshape industries across the global economy. Apple risks becoming one of its casualties, and he's raising questions about the future of Tim Cook. What would you like to know from Walt later on this morning?
Well, I'd ask him who on earth would replace Tim Cook. The short list of candidates for that role is very interesting. Mark Gurman reports all the time, right, about the change in unit leaders and lieutenants, but the CEO is a different thing. The reporting on this new lineup of devices next spring is really interesting. It's very analogous to Tesla. The future may be AI, but in the near term, the bread and butter of revenue growth is in refresh of devices, and quite clearly they're being aggressive based on Mark's reporting to get more out there into the world at various price points and continue getting people to have Apple products in their hands so that when AI does come, they'll be able to use it somehow. But on the CEO question, ask him who. I'd love to build a short list.
Apple down this morning by 0.6%. Ed, thank you, sir. Ed Ludlow with the latest provocative piece from Walter Piecyk this week.
And it highlights how much Apple has been left behind by the dynamism that we've seen in the big tech in the United States, and a real existential angst there about what they can do to really turn that around.
Do they have to get a little bit more acquisitive? Do they have to make a big buy, a big purchase?
Do they have to do what Meta's doing and maybe do that big purchase in the form of signing bonuses back for their employees that were poached by Meta just in the past few weeks?
Let's build on some of these conversations. Angelo Zeno of CFRA joins us now for more. Angelo, I want to start with Nvidia. A theme of your research over the past few months is that Nvidia has de-risked the China story. Could you just explain to all of us how they've gone about doing just that?
Yeah, no, thanks, John. So, for the most part, you kind of look at just their most recent results, and they've essentially come out and zeroed out the potential for China, when they've actually also said that there was an $8 billion opportunity in the quarter that they're missing out on because of China. So we know there's a massive opportunity and a growing opportunity out in China. But in the same respect, we know they've de-risked it because they've essentially zeroed it out. And we'd expect China at this point to represent less than 5% of sales from the company, essentially all of it coming from gaming and what have you. So that's what we mean by it being de-risked. I'd also say this, when we saw the reversal of the EDA software restrictions kind of lifted last week, I think that is also kind of increasing the sentiment out there, or belief that potentially Nvidia does have that opportunity to get back into China. You just kind of heard Ed talk about that opportunity as well in terms of a new potential chip out there. So I think when you kind of look at the dynamics right now, it's tilting more favorably towards Nvidia potentially getting back in there, with the respect that right now there's nothing coming from that region as well.
Angelo, there's sort of this deeper psychological question, and it's been underpinned by what Ed was outlining from Jensen Huang, what he was saying over the weekend, that ultimately if the U.S. wants to be dominant in this sphere, which is like being the reserve currency, that it needs to allow a greater degree of sales into China. Do we have any sense of how much that message is resonating in the White House?
I mean, I think it has to be resonating to some extent because, I mean, it seems like, at least right now, the Jensen's got Trump's ears in some respect. I mean, they're having face-to-face meetings. I think that's definitely a good thing, more so than I think, some of these other tech leaders are having. So, I think it's resonating to an extent. I think Trump, it definitely respects Jensen. And at the end of the day, I mean, just looking at some of the recent moves that we've seen, again, with that software ban, and just potentially using Nvidia's chip as a bargaining chip, their business as a bargaining chip, like we saw with Saudi Arabia. I think just it points to the fact that, hey, listen, it is resonating that they're not necessarily looking to block Nvidia out across the globe. But they do want to leverage Nvidia with these trade deals out there. So I think it's more along the lines of investors at this point being patient. But I do think ultimately you do see Nvidia, again, back into China as well as other regions of the globe.
I wonder how much it's important for analysts like yourself to see Jensen Huang with the ear of the president. And who doesn't have the ear of the president? And I'm thinking of Tim Cook of Apple, who seems to be falling off the bandwagon when it comes to his favorability in the president's eyes. How much do you agree with Walter Piecyk of Lightshed, as John was talking about, this idea that this is somebody who no longer really has the creative or even diplomatic helm of Apple in a way that benefits the company?
Yeah, I mean, listen, we are a little bit worried about Apple in the sense that, historically they've been very slow to move to changes, right? I mean, and it's worked in the past in the sense of, hey, listen, we want to make sure we get this right. And we're not going to be, quick to move, and we don't necessarily need to be the first ones out there. However, in an AI-driven environment, things move really, really fast. And in that type of environment, I do think Apple needs to change to an extent. Now, it doesn't necessarily mean that they have to, get rid of Tim Cook. I'd probably say that's something you don't want to do at this point in time. And the reason for that is because we are seeing a number of departures at the company. At the very least, right now, I think you need to hold on. You want to hold on to Tim Cook and have that solidified, at least at the CEO level. So, but I do think changes need to be made. I do think the company needs to work faster. Again, does it need to be done via some M&A, just acquiring more talent the way Meta has? I think all those should be on the table at this point in time. But the most important thing right now, I think, is really kind of getting the Siri integration across the App Store right. And they need to get that done here within the next 9 to 12 months to at least restore some credibility within the company and with some of their developers.
Do you think that's achievable with the tools and the talent they have in-house right now, Angelo? I think that's the ultimate question.
To be honest with you, I don't know. The answer probably no. And I think the reason I say that right now is because they are looking elsewhere in terms of, the perplexities of the world and what have you to at least fill a void, or even, via Anthropic or an OpenAI. So I think Apple realizes they are behind, but it's actually a good thing that at least they've realized that and they're trying to do something about it. And as long as they can fill that void, whether it be, temporary or what have you, that's extremely important, I think, for investors at this point in time.
Angelo, I appreciate your time. As always, thank you, sir. Angelo Zino there of CFRA on both Nvidia and on Apple. Walter Piecyk joining us in about 20 minutes.
Yeah, seeing Tim Cook as the departure that they would need. Do they need a departure or do they need an acquisition? Or do they need something of both? And if they do need to make an acquisition, who would lead it if it wasn't Tim Cook, to Ed's point?
And can they close it? Or does the regulator step in and have something to say about that?
Yeah, that's sort of the brilliance of the Meta plan, right? The backdoor acquisition, the backdoor, just sort of acquire the talent and you essentially have the company.
Walter Piecyk, later this hour. Don't miss that conversation. Up next, Steve Rasciuto of Mizuho on a shock-proof economy. Plus, Yahara Anand with your morning movers and another potential deal, this time in the food space. Live from New York City this morning. Good morning. You're watching Bloomberg TV. $60 minutes away from the opening bow. 2 days of gains into Friday, pulling back by just 0.6% so far this morning. We're down by 0.5% on the Nasdaq 100. With your morning movers, let's cross over to Yahara Anand for more. Hey, Yahara.
Hi, John. We start with performance foods surging on takeover speculation. It is up 6.7%. We are reporting that U.S. Foods is exploring an acquisition that would create a $100 billion food distribution giant. Both companies supply food to restaurants and stores across North America. And it feels like we're hearing more and more about these deals or potential deals, which brings us back to what Delta CEO Ed Bastian had to say yesterday, that there is clarity to invest and that the environment is incredibly stable. So these trends speaking to that. Next up, we have Freeport-McMoRan. The American mining giant is down 2.6%. We've mentioned this stock a lot this week because it was one that was understood that could stand to benefit from President Trump's copper tariffs. But UBS just hit it with a downgrade to neutral. Analysts there expect a softening in demand and fundamentals to weigh on copper prices over the next 6 months. And we end with Levi Strauss. It is surging up 7.75%. The jeans giant hiked its full year revenue forecast, saying that despite all the added costs from tariffs, it sees sales rising 2% this year. That's due to strong demand and a strategy shift that's been working, which is to provide head-to-toe denim. So not just focusing on jeans, but also denim accessories and clothing. John, I'd love to see you in head-to-toe denim.
Yeah, I don't know about that. What do they call that? Canadian tuxedo? Isn't that what they call that? I think that's what they call that. I think that's what they call that.
I think it's a 1980s uniform.
Yeah, I just have no interest in it
really?
whatsoever.
I think you would actually like a man purse in denim.
Yeah, no.
Absolutely has your name written all over
it.
Yep, 100%.
Yahara, thanks for that, I think. That's a hard no from me. Standout line this week, there's been many. Savita Subramaniam, never underestimate corporate America. And you're seeing signs of that, even from the likes of Levi's and other companies too.
Yeah, and even Aritzia, they came out and they said that they are happy that the tariffs on Chinese goods weren't higher. And that's one reason why they don't have to raise prices, and they actually are boosting expectations. You look at all of this, and it explains why there is a sense that U.S. corporations can adapt to anything, including 10 to 15% tariffs, or dare I say 15 to 20% tariffs? I guess that's the real question.
TK's favorite phrase. He's always said it for years and years and years.
I know.
They adapt and they
adjust.
There we go.
And I've been repeating it, and I feel like a little Tom Keene clone because I keep repeating that phrase because he's correct. We've seen that time and time again.
This equity market close to all-time highs. Looking ahead to data next week, CPI in focus. We've had 4 months of softer than expected core inflation. Can we make it month 5? Joining us now is Bloomberg's Mike McKee. Good morning, Mike.
Good morning, John. Well, that's one of the key questions out there for American companies. And I'm here in Jackson at the Global Interdependence Center's Teton Economic Forecast. This conference looked like the Bloomberg TV green room. Everybody that you have on the air on a regular basis was here. And the general feeling was at this point that you should keep buying in the equity markets. The equity markets will be the ones that react the most if and when we get this inflation that's expected. But we haven't got it so far. The forecast for Tuesday is that we get a slight increase in prices, but everybody's going to be looking at what's below it. And really, July is not on the table. Take a look at what's ahead of us now. We've got 3 jobs reports. We've got 3 CPI reports before the September meeting, just one of each before the July meeting. And according to most of the people here, they're not expecting to see a whole lot of evidence that the inflation rate is going up or that jobs are going down before the September meeting. Once you get the 3 months in there, then they feel there's a chance you need to start looking at different alternatives to investing. But for right now, stay in there.
Mike, noise or signal? I think we've had this debate over the last several months. And when you talk to people about the goods economy, they say things like, we've got all this pre-tariff inventory that we've been working through. Don't take it as signal. It's noise. And what you're going to see in the months later is a pickup in prices again. Do you lend much weight to that theory, Mike?
Well, the theory makes a lot of sense, and it may come true. The biggest issue, John, is that the president keeps putting off the tariffs, giving companies a chance to continue to hold on to those inventories or restock them a little bit. The reports we've had, of course, from ports of Los Angeles, people like that, is that we're seeing far fewer imports. And if that's the case, it will start to show up. And when the tariffs go on, then it should start to show up in a much bigger way. In the May CPI report, we saw washing machine prices go up because the president raised tariffs on steel. Once tariffs go in for other products, then Americans are going to see some higher prices, whether companies can absorb a lot of it or not.
Mike, thank you. Just one final question. Why is it always the Grand Tetons? Why is it always Jackson?
You know, I have a theory about that now. We talked to somebody who's on the town council here, and they pointed out that Jackson is in Teton County. Teton County is the wealthiest county in the United States. There's an awful lot of billionaires who live here, and so it attracts people who manage their money.
There we go. Michael McKee, thank you, sir. That's a decent explanation. It's not the fishing. It's because of the money.
Okay, that actually would make more sense. The problem with that, with all due respect, Mike, is that this has been the case since the 1970s. They've been going to Jackson Hole for a long time. So the fact that this is now the hub of economic theory, it's bears, elk, and economists. And I do wonder if it's partly because there is a proclivity of academics to go hiking. I actually think that that's what it is. And so you might as well go somewhere that's beautiful and rugged and you can expence the great outdoors.
It was Volcker and fly fishing, wasn't it?
Well,
isn't that what it was about?
Yeah, it's fly fishing, it's Camp Kotak,
like
it's like baseball or cricket.
Okay. Anyway, Steve Risciuto of Mizuho writes in the following: the lack of systemic risk in the economy should ensure the economy will remain as impervious to shock. Steve joins us now for more. Steve, good morning. It's good to see you. Let's talk about that. The shock-proof economy. We've been teasing it all morning ahead of your appearance. What is so shock-proof about this economy? What makes it shock-proof?
Well, as I indicated, there's no systemic risk. There's no asset-liability mismatches, and there's no asset price bubbles. So typically systemic risk occurs when there's an asset price bubble that is funded by an asset-liability mismatch, i.e. you've borrowed short and invested long. And the rising asset price bubble, eventually a curve inversion changes the economics, the bubble bursts, capital's destroyed, and when capital's destroyed, liquidity just sucks out of the economy. In an environment where assets and liabilities are matched and there's no asset price bubble, a curve inversion had no impact. And the economy, because balance sheets, when you go down the chain through non-financial corporates, households, banks, shadow banks, because the balance sheets are strong, everyone's deleveraging, everyone has very, very exceptionally low debt servicing costs and relatively long duration. You're in an environment where nobody has rollover risk, nobody feels the impact of anything that happens from the interest rate environment, and therefore you don't have the same kind of credit-related issues that have typically popped up and caused a problem.
Is this a shock-proof economy or a shock-proof market?
Oh, no, it's a shock-proof economy because corporations are in this position as well. Non-financial corporations' debt service burdens go back to 1960 levels. And they've been deleveraging since the financial crisis. Even though we have record corporate issuance, the amount of corporate debt outstanding is actually continuing to go down because we refinance less than we're actually maturing off. Corporations in this country are cash rich. And we see that in terms of their cash positions, whether it's the Mag 7 or even when you go down the chain of to smaller and smaller companies, you see this buildup of cash that has taken place. It's one of the reasons why there's an excess supply of savings in the economy that's helping to dampen long-term interest rates.
Okay, so this is a reason why the economy hasn't tanked and why you haven't seen any kind of real deterioration in equity valuations. But can you see ongoing strength in the face of potential, I don't want to say shock, but changes, real changes to trade and potential tariffs that could be much higher than people are currently expecting?
Again, because of the ability for companies in this very solid financial position to adjust their businesses, which gets back to your Tom Keene quote, you wind up in an environment where basically you have the ability to adjust quicker than people think. And this is really what sets the U.S. economy largely apart because we are the largest, most leveraged nation in the world. So you have to understand credit to understand how the economy functions. And in an environment where credit quality is excellent, you see that in spreads, you're seeing an environment in which there's really no issue. People can get the funding they need to morph their businesses, or they just use it out of internal earnings.
One additional task now for economists is to navigate policy coming from this White House and really understand what the strategy is, if there is one. You've pushed back against the people that have suggested there isn't one. You believe there is. Yeah. So let's get into that. What is the strategy?
Well, I think you have to understand the strategy is on three-dimensional. There's geopolitical, there's socioeconomic, and macroeconomic. And we in our business tend to just think in the macroeconomic plane. But you look at things like what Trump is doing, like what he just did with Brazil, what he's doing with China. Those are geopolitical issues. Then you look at Mexico, and it's largely a socioeconomic issue. So you've got to take apart some of these things that seem irrational from a macroeconomic standpoint and then look at the macroeconomic piece of it and say, well, what he's doing so far is basically attempting to create a level playing field, which corporate America kind of likes, number one. Number two, he really keeps on, as we indicated with Mike McKee, keeps on pushing out the dates of these tariffs, and people are beginning to recognize it is a negotiating trick on his side. So you begin to back away from the paranoia that comes out of it, and you have to ask yourself a question. Does Donald Trump really want to destroy the economy going into the midterm elections? The answer is no. I think Donald Trump wants to try to expand his polarity in the midterm elections to do what he really wants to do, which is drain the swamp, which means he needs a bigger majority in Congress to change some of the laws that have been keeping us with a structural deficit of $2 trillion.
Is that a recipe that comes with higher yields or lower yields, higher rates or lower rates?
I think the risk is it comes with higher inflation and with it higher yields. I think the presumption that the market has had continuously that the Fed needs to cut interest rates because the economy is somehow or another weakening. This economy is capable of running a trend. And when you throw fiscal stimulus on it, you will get above trend. And even though you could say over the long term, the Trump tax cut and the tariffs may net out, in the 2025-2026 period in particular, the tax cut is front loaded. So you wind up with the net stimulus helping to lift the economy in 2026.
Given that, if the Federal Reserve does cut rates this year, will that lead to hotter than expected inflation in the medium term that challenges that?
I think it'll lead to a backup in yields almost every bit as much as they cut short-term interest rates, as we saw happen last year. I think when you cut interest rates when you don't need to cut interest rates, it's not a good policy prescription. And they clearly made a mistake last year. And I think they're sitting here this year with, as Mike indicated, you've all indicated, that you have situations in terms of the potential of tariffs coming down the pipeline to lift prices. And you have an economy that's proving to be very, very resilient. You've got a labor market that's proving to be very resilient. What would be the benefit of cutting interest rates?
Steve, you've called the economy really well so far. Credit to you. It's good to catch up. Thank you. Thank you very much. Steve Rashuda there of Mizuho. That's the situation in the economy, the situation in the market so far. Going into the weekend, equities just a little bit softer. The opening bell about 50 minutes away. With an update on stories elsewhere with your Bloomberg Brief, here's Lizzie Burden. Hey, Lizzie.
Hey, John. Secretary of State Marco Rubio met his Chinese counterpart on the sidelines of the ASEAN talks in Malaysia. It's the first in-person meeting between the two since President Trump returned to the White House. After the meeting, Rubio told reporters odds are high for a meeting between Presidents Trump and China's Xi Jinping. Elsewhere, Tesla is planning to expand its robo-taxi service into California and Arizona after its recent rollout in Texas. CEO Elon Musk expects the driverless cars could launch in the San Francisco Bay Area in a month or two. Tesla's also applied to operate in Phoenix, and a decision is expected by the end of this month. And Goldman Sachs is piloting its first AI software engineer. Goldman's tech chief Marco Argenti told CNBC that the bank has partnered up with AI startup Cognition for the endeavour. The company plans to start augmenting its workforce with the AI engineer that is named Devin. And that's been my brief, John.
Lizzie, thank you, and thanks for everything this week here in New York. Lizzie Burden there. Thank you very much. Up next on the programme, we'll set you up for the day ahead. Plus, Walter Piecyk of Lightshed Partners calling for disruptive change at Apple. The future of Tim Cook. Up next.
I think we're going to see inflation a little bit elevated here. Then growth is going to remain pretty strong. We're going to have positive stimulus from the fiscal bill, and it's going to be just a tough backdrop for them to cut. Eventually they will. They certainly want to, and it makes perfect sense for them to get there. It's just going to take some time. I think we're talking mid-2026.
Stephanie Roth of Wolf Research with, I think, the call of the morning so far. I hope the president's not listening. The middle of 2026. For the first interest rate cut from this Federal Reserve.
Yeah, at the same time, isn't this kind of what he wants, the economy to hold in there, to allow him to continue with the negotiating tools? So on one hand, yes, this isn't what he wants. On the other hand, well, maybe it is when it comes to the economic implications.
Counting you down to the opening bell with equity futures negative here by 0.5%. As we get to the weekend, a sneak peek of next week, Tuesday. Bank earnings kicking off with JP Morgan, Citi, Wells Fargo, plus CPI inflation data the very same morning. On Wednesday, earnings from Bank of America, Goldman, Morgan Stanley, and some PPI data. Thursday, another round of claims plus retail sales. And on Friday, going into next weekend, UMich consumer sentiment. That's all for next week. On the here and now, let's talk about tech. A management shakeup at Apple as its COO plans to step down. Our next guest thinks it should also consider replacing longtime CEO Tim Cook. Walter Piecyk of Lightshed Partners writing, Apple now needs a product-focused CEO. Not one centered on logistics. It's time for more disruptive change and not less. Walt joins us now for more. Walt, it's been too long, my friend. It's good to catch up with you. Let's just start with the core issue here. What do you think the problem is at Apple right now?
Well, they're just missing product cycles. I mean, the big one now is AI. It's one thing to pull the string on things like Apple TV, which were predicted for years and never happened, or Project Titan, a much bigger one, which was an autonomous car. I was just down in Austin. The autonomous industry down in Austin is obviously thriving. Huge opportunity, I think, missed by stopping that program. But this newest version, and frankly, autonomy is a version of AI, but AI in general, not only is a missed revenue opportunity, but if you're not a major player there and you're one of these large companies like Apple, Google, whoever, that in itself can disrupt you. And they are clearly far behind. They overpromised a year ago, and that's being kind to call that overpromising. They said that they were going to have all of these AI features. None of them developed. We all use Siri. It still is not a good service. This is a real risk to the company. This is to say nothing of Tim Cook being an incredible CEO for what they needed during this iPhone era with logistics. But now you clearly need someone that can move forward on a lot of the product development. This company spends, John, $35 billion a year in R&D. It has risen as a percent of their revenue to 8% of revenue. And it was only, what, 3, 4, 5% 10, 15 years ago. $35 billion a year on new products. And we've seen the stuff like the HomePod or the Vision Pro, which I, blew $4,000 on and haven't seen any app development of note on there. We need someone in there to kind of not only develop those products, but have the confidence to push them forward to commercialization.
Well, is it something that can be solved just with an acquisition? Whether that's an acquisition of a company or doing what Mark Zuckerberg's doing over at Meta and just acquiring lots and lots of very expensive talent? Why does it require the ultimate story change, which is to get rid of the leader right now?
Apple does tons of acquisitions. They're buying small companies all the time and developing multiple teams within the organization to develop products. In terms of mega acquisitions, I mean, okay, go and try buy Netflix. Go try and buy ChatGPT. The one people are talking about, Perplexity, as everyone mentions, is a wrapper. And then there's a wrapper of LLMs. It's not its own LLM. And the assumption is that this LLM or this wrapper is somehow going to be able to integrate with all of the very valuable information that Apple holds dear from their users that's private within the phone. Where we're saying, the AI experience is only going to work in the iPhone because that's what everyone uses. And the assumption then is that Perplexity, not an LLM, a wrapper, is going to have the expertise, like a ChatGPT, to somehow integrate that data and do deep integration. I don't know whether that's true or false, but everyone's just assuming that Perplexity is going to fix it. It's certainly going to put them in a better place in terms of the user experience, but I'm not sure that necessarily provides this deep integration that everyone expects, or just effectively disintermediates the company altogether, because if they're just passing you through to ChatGPT and Sam Altman comes up with a better interface in working with Johnny Ives in terms of how you want to get access to your data, again, these create existential risks for the company.
So, Walter, I'm going to lean on Ed Ludlow here. Who would take over Tim Cook's role? I mean, who do you see as being a better CEO for Apple?
I mean, that's not my job. That's the board's job. And frankly, that's Tim Cook's job. The suggestion that only Tim Cook is the CEO to run this company is crazy, right? I mean, I've been doing this for 30 years. I've covered plenty of large companies. It is the CEO's job and the board's job to develop a bench that can handle changes that are in the company. And if they don't have a succession in place today, a CEO internal at the company that can take over this company today, that in and itself is a failure of the CEO of the company as well as the board. But there's, look, we can all just ask ChatGPT to come up with answers. There's plenty of answers of CEOs out there that are product focused, maybe some former Apple employees that can take over an Apple. But the suggestion that Tim Cook is the only one that can run this company, I've never heard that before.
Walter, I've got to say, before we started, we actually were asking both ChatGPT and Siri different questions, and Siri just gave us Google results, and ChatGPT gave us very thought-out questions to ask Tim Cook, acquisition targets, why they would choose not to, and it was very well thought out. So to your point, that does seem like an alternative. I just wonder what happens to Apple if they are unable to make some sort of radical change and shake things up. Does it leave the Magnificent Seven? Does it become obsolete? Is there somebody else, another company that eats its lunch?
Look, Apple, great company. It's almost like in some ways I've heard people say it's an alternative to treasuries. It's a constant bid. But I also heard 2 years ago, plenty of people say the market can't go up if Apple doesn't go up. How can you be negative on Apple? You're negative on the market. And here we are, the market's at an all-time high. Right. We have leadership changes, which always happens. Right. Everyone always, gets very upset about, it's only 7 or 8 stocks. Those 7 or 8 stocks obviously change over time. Apple's down, markets at a high. If they don't, execute on AI, they're just going to fall further back. And, they're still getting a premium multiple in the marketplace. It's a company that doesn't grow. You have very bullish analysts that come on this program and everywhere else, and they miss. And guidance misses, and they're like, well, don't worry, because revenue is going to get back to 5 or 10% in the quarter after guidance. And then we move forward a quarter, and they just pull the string and say the same thing over and over, and the company never returns to the growth that they're expecting. So if you miss AI and you can't get back to growth, at some point, investors get fed up. The multiple contracts back to where the market is, or perhaps lower, because you can't grow the company. And that is, again, the risk that this company has. When it becomes clear that we're, beyond the internet era into the AI era, we have new leaders, and you effectively lose that premium in the marketplace. People used to tell me that AT&T could never trade at a premium to Verizon. Verizon was the quality company out there. And look where we are today.
Well, just a final question, just to repeat some of what Lisa said. If they're the casualty, who's the winner? Who are you thinking about? Where would you place your bets right now?
That is what is awesome about this AI world that we're about to enter, John. That I don't know. I mean, there are so many companies that are looking at in Google search, same issue, right? I don't even use Google search anymore. I only ChatGPT all of my, all of the stuff that I'm looking at. So that's what's exciting about what new entrant can come up. That's what's great about our economy. That's what's great about a non-regulated, competitive economy. You have new competitors that can come in and change things. John, I've been doing this long enough.
Yep.
People said Motorola would never, would be the one forever. BlackBerry, we'd never get rid of our BlackBerries. Nokia, I'm not saying that this is the next BlackBerry, but we are at a time when technology provides an opportunity for disruption. And when there's disruption, you have new entrants come out of nowhere with a great solution. And that's what's so exciting about AI and why I'm so happy to be able to cover this space for the next 10 years.
I've known you a long time, and you don't make headlines just for the sake of it. Provocative piece. Loved catching up. Well, thank you, sir. Walter Piecyk there of Lightshed Partners.
Do you think it's going to be even a phone? Do you think it could be an earpiece? Do you think it could be glasses? Do you think it's just, an implant in our brains?
I'm going to say what Walt said. I've got no idea.
Me neither.
Coming up on the programme on Monday, Peter Chia of Academy Securities, Tom Becker of BlackRock, Vito Spaduto of RBC Capital Markets, and Judy Beale of Kane Anderson Rudnick from New York. Have a wonderful weekend. This was Bloomberg Surveillance.
Today we expect more from technology. Companies making the biggest productivity gains aren't just adding more tools, they're choosing integrated solutions. Find out more about these solutions later in this podcast.
News when you want it with Bloomberg News Now. I'm Nathan Hager. A new trading week begins with investors pulling stocks back just a bit from record levels. That's the sound of the opening bell from the floor of the New York Stock Exchange on this Monday morning. The S&P 500 opens about 0.1% lower, down about 6 points, trading just above 6250. The Dow Jones Industrial Average is lower by 0.1% as well, down about 60 points. The NASDAQ Composite is little changed at the open, trading close to 20,600. So Wall Street's getting the week off to a tentative start following the latest trade threats from President Trump. 30% duties, he says, on the European Union and Mexico. Now the EU is considering its response. Here's the bloc's top trade negotiator, Maroš Šefčovič.
An idea of 30% tariff rate is effectively prohibitive to the mutual trade. We remain convinced that our transatlantic relationship deserved a negotiated solution.
EU Trade Chief Maroš Šefčovič says he'll speak with his U.S. counterparts today. As Bloomberg News has learned, the EU is also reaching out to other nations that have come under the president's trade crosshairs. Bloomberg's Stephen Carroll is tracking that from Brussels.
That's framed very tentatively as these are simple contacts between, I suppose, like-minded countries would be how the EU would think about it on the trade front as well. But it does give us an indication of how the EU is thinking about this from a global perspective, and not just from the letter that they got over the weekend with the 30% tariff rate that Donald Trump announced, which came as a surprise to many in Brussels.
Bloomberg's Stephen Carroll reports European Commission President Ursula von der Leyen also plans to speak later today with Canadian Prime Minister Mark Carney. Both those countries have seen their trade talks drag with the U.S. This morning, President Trump meets with NATO Secretary General Mark Rutte. They're expected to make a major announcement on the war in Ukraine after the president said he would send more Patriot air defense systems to that country paid for by NATO. Bloomberg's Rosalind Matheson has more.
It really does seem to reflect, more than anything else, a growing sense of frustration with the Russian leader, Vladimir Putin, that for all the talk and months of that, there's been no progress towards a ceasefire, and Trump's growing realization, essentially, that Putin is basically playing him for time. So that's starting to show up in slightly more tangible ways, including this.
Bloomberg's Roz Matheson reporting. Meantime, Ukrainian President Volodymyr Zelensky says he had a very productive meeting today with President Trump's Ukraine envoy, Keith Kellogg. Zelensky also announced he's naming Deputy Premier Yulia Svirodenko to replace Denis Shmyhal as Ukraine's prime minister. Svirodenko took the lead in coordinating Ukraine's minerals deal with the U.S. earlier this year. Fed Chair Jerome Powell has reportedly asked the central bank's inspector general to review the Fed's $2.5 billion headquarters renovation. That's according to a report from Axios, as White House officials keep up the pressure on Powell to resign over cost overruns on the project. White House economic advisor Kevin Hassett kept up that pressure in an interview on CNBC this morning.
I think that we definitely need to rethink the way the Fed's acting. We 100% want independent monetary policy, but it sure looks like they need more congressional oversight on things like the way they build their buildings.
National Economic Council Director Kevin Hassett. Meantime, Cleveland Fed President Beth Hammack is putting herself in the wait-and-see camp when it comes to interest rates. In an interview with Fox Business today, Hammack said she wants to see how new policies affect inflation before she would support a cut. The next read on prices comes tomorrow in the June Consumer Price Index. In southern Massachusetts,
we had an unspeakable tragedy here in Fall River last night.
Fire chief in Fall River, Mass, Jeffrey Bacon, said that fire tore through the Gabriel House assisted living home. At least 30 others were injured as the flames left many residents inside trapped.
My heart goes out to the families, those who were injured, and especially the 9 who lost their lives.
Chief Bacon says about 50 firefighters responded, including 30 who were off duty. Exactly where and how that fire started is still under investigation. In Central Texas, the search for victims of the July 4th floods is set to resume today after more heavy rains over the weekend put that effort on hold yesterday. The death toll is now past 130. 162 more may still be missing. There is still a flood watch in effect through tonight for Texas Hill Country. And that's news when you want it. With Bloomberg News Now, I'm Nathan Hager, and this is Bloomberg.
Remember when a single technology glitch could bring an entire workday to a standstill? I'm Mark Banfield, Chief Commercial Officer at TeamViewer. Today, most technical issues are recurring. If you know the patterns, these issues can be remediated before they impact your business. One major UK retailer discovered a single point of sale outage cost them around $1 million in lost sales during a single lunchtime. Now, using TeamViewer's digital workplace platform, the same company is able to identify and fix those issues before they even happen. But proactive troubleshooting isn't just about the incremental improvements. It's about fundamentally reimagining how work happens for everyone. And the companies that move first get competitive advantages in terms of efficiency, productivity, and innovation. To find out more, visit bloomberg.com/TeamViewer.
The data that matters for your investments.
Shares of banks across the board are gaining.
And analysis on the companies making news on Wall Street.
Nvidia, once again, the top dog.
Tesla's really taking a hit this morning.
Listen to the Stock Movers Report from Bloomberg.
Wind and solar stocks on the move.
It's your short audio report on the day's winners and losers in the stock market.
The biggest one-day decline since 2010.
Subscribe to the Stock Movers Report on Apple Podcasts, Spotify, or wherever you listen.
In a world of seismic change, will your business shape the future or be
Brazil is notably the most important coffee-producing country. So working in coffee, it's mandatory to have coffee coming from Brazil. It's part of the recipes, it's part of the coffee people enjoy every day in the world. So having tariff for US on Brazilian import coffee, of course, it means that the price of the coffee cup in Brazil has to rise quite a lot. 50% is a really high tariff, so it could create a lot of inflation in our industry that's already under stress because the problem of green coffee beans that notably soared very, very much during the past 4 years.
But Giuseppe, I mean, Arabica prices are fluctuating sharply this morning. Again, is this an early, sign indicator? And if you look at the Brazilian Arabica market, can it be shipped to Italy? I mean, does it change supply chains, or is it something, or have agreements been signed like years and years ago?
No, there are not long-term agreements in this industry. So normally you can decide to buy coffee from different countries. So of course, if some tariff hits a specific country, roasters try to avoid to use a very expensive coffee. Maybe they try to shift to other coffee. But nevertheless, Brazil is so relevant in coffee industry. It counts for about 40% of the total production. And with Vietnam, they altogether counts about 55%. So not having Brazil coffee disposable means distortion in the market, restriction in the coffee availability, and so high tension on the prices of green coffee around the world.
What does it mean for Lavazza? And again, you could have this massive dislocation between future prices and also spot price.
But yeah, we try, of course, to manage quite carefully the prices of coffee. But for Europe, this is a different situation because we don't have this system of tariffs. So we can, for example, buy our coffee. We have other issues, of course, high coffee prices, U.S. regulation that acts more or less as tariff because it reduces the quantity of coffee we can buy from different countries. So it's a pretty tough environment, and I hope lawmakers have the sensitiveness to understand this.
But so it doesn't necessarily impact actually the, where you buy your sources. I mean, it doesn't necessarily impact your sourcing strategies, basically.
No, really not. Of course, we try to keep strictly under control the quality of our products. So despite high prices, despite this kind, for example, of difficult situation, dire straits, we keep pay a lot of attention to the quality of our recipe. Yeah. We don't accept any kind of compromise in terms of composition of our blend. This is part of the trust that we build with our customers and consumers around the world.
Do you think U.S. roasters need to start reformulating actually some of their sourcing? And so does that, again, is it competitive advantage if tariffs aren't too hard on you coming from Europe?
Of course, the market move from one side to another one. If there are this kind of distortion in the market, we try to mitigate. But nevertheless, remember that for Lavazza, the taste of the products is very important. So we have some limits to do that. The most important things for us is to deliver to our consumer the highest possible experience in terms of coffee. So we can't modify, for example, the composition of our blends. We have some limits, and we can do, but with very, very short space. So more or less, the kind of coffee we have to buy every year is the same. If there are tariffs, of course, this means that the cost of coffee is higher. And so we have to deal with a situation of pressure again on cost, on supply chain, on negotiation with our customers. That's very, very dangerous situation, very tough.
But would you be able, given the consumer right now, would you be able to increase prices in certain markets?
We try, of course, to act very responsibly because, of course, we wanted to keep high our competitiveness, protect the customer, of course, and, of course, to try not to threat the trust relationship we have with the retailers, for example. But just to give you an idea, in 2019, the cost of coffee for Lavazza was about 6 million euros for 1 year. and nowadays in 2024 is about 1.6 billion euros. So really a relevant shift. We can try to absorb some of cost in our balance sheet, but we also have the necessity to adjust the prices and so to have a price increase in certain geographies, in certain markets.
So a disclaimer, I love coffee and I have too many espressos probably. Where do you want to expand? I mean, you're known for the coffee, the espresso, the capsules in certain places. Is there an area that you're looking at? I was surprised to see, for example, Ferrero looking to buy Kellogg's. Is there something that you think that you want to get into which is away from coffee?
No, we are very focused on coffee. This is our mission since 1895. The company has a specific strategy to expand in interesting geographies, as notably North America, China, and even to try to cover all possible channels where people like to have coffee. Retail, away from home, e-commerce is growing quite a lot. And vending as well is another very interesting channel. So we try to expand in all these directions, but stay very, very stuck on coffee.
Very close to coffee.
Yeah.
This is probably very good news for coffee lovers. How do you see the China market actually evolving? I mean, it's a nation of tea drinkers, but you see actually pockets, especially in urban cities, where I guess gourmet coffee is really taking up.
China is quite a very interesting potential country. Over the last 3 years, coffee consumption rose about 60%. It's a good sign. Chinese people love coffee, especially if it mixes with milk. They love a lot of recipe. And it's a high competitive market. A lot of coffee shops are active in China. We have a very interesting partnership with a Chinese partner, Yum China, with the aim of open around 1,000 coffee shops by 2028. We are about 100. We're testing our concept, but very confident that China will represent the future of the company in Asia.
So what kind of growth are you looking at? Is it like 20% growth for coffee drinkers?
In China?
Yeah.
Oh, yeah. I think that China, the dimension of the business in China is huge. So if we consider that now is the first stage of the coffee in China, the potential of the market is exceptional. So I think one Chinese can drink one coffee per day. It means that the world of green coffee has to double or to triple. So we need to have a lot of coffee production in the producing country to satisfy such a huge demand. So very good news for producers.
In France, when we do something, it often ends up iconic. This radio antenna, for example, iconic. Or a gift to a friend, iconic. When we aim high, when we really take off. Iconic. Why? Because we do things our way. Stylish, bold, exploring, innovating, carrying our history and values into the future. Make it iconic. Choose France.
This company has been around for 58 years, so we have gone through many different economic, geopolitical silos, phenomenons. Of course, tariffs is a factor right now for us. We're really focused on the consumer and making sure that we're delivering to the consumer amazing value and something that's engaging from an emotional standpoint. The situation on tariffs, as you know, continues to evolve. We've run a number of different scenarios. We have a proven toolkit of how to manage cost headwinds. We've had prior cost headwinds. If you think about the price of cotton, that increased dramatically as a result of COVID. So the combination of diversified sourcing, as you mentioned up front, the fact that we have strategic partnership with a number of our suppliers, we can really work efficiencies throughout the entire chain. And then a brand that's got strong pricing power so that if and when needed, we can take selective pricing and promotional activities. I think positions us well in this environment of uncertainty. Again, all of our energy is making sure we're getting the consumer excited about our storytelling, about our products, and providing great experiences around the world.
And Patrice, how is the consumer doing? So what are they looking for? Is it in terms of brand recognition? It's there. Do they want upper end? Is it middle end? Do you see a change in behavior at the margins?
So it's pretty clear that around the world, and I've been traveling a lot recently, I was in China just a few months ago and parts of Europe this week, there's a high level of uncertainty, and that's likely to continue. I think what we are seeing in general is consumers are looking for brands that are dependable, consistent, timeless. And when you look at our core consumers, which is a subgroup of the broader population, our core consumers are actually still very, very resilient. And that's true in Sydney, in Shanghai, in Milan, in London, in Los Angeles. And I think what the consumer is telling us is they really appreciate the values of authenticity, optimism, right? We need optimism at this time, timelessness, aspiration. That resonates with them, and from what we are seeing, our consumer continues to be strong around the world.
I mean, we went for their brands with many logos being very popular to quite luxury. You say timeless. Has it gone into a different direction where actually people want to hear stories, want to hear family stories, and has that changed? Or, I mean, you're also selling like Americana. What does that mean to you?
Yeah, I think it's very interesting. During times of uncertainty like the ones we're in right now, we do see consumers gravitate to brands that they know, products that they trust. They're more discerning with their dollars, right? The consumer is smart. They recognize quality when they see quality. And so what's very interesting when you look at the part of our lineup that is responding really nicely right now, it's our core products. It's our cable knit sweaters. It's our tweed jackets. It's our Oxford shirts. It's, of course, our polo shirts. It's our pony cap. So that's actually the breadth of our lifestyle portfolio is actually serving us very well here. And the core that the consumer knows well from Ralph Lauren is really resonating. Again, what's exciting about the company performance right now is the breadth of performance wherever you look, by market, by channel, by consumer group.
Where do you see more opportunities? Is it in women's wear? Is it? I know you also are quite big in homeware.
Right.
Is it what's growing the most?
So what's exciting about this brand is it's a true lifestyle brand, right? We serve generations from newborns to 90-year-olds, and we sell a pack of tennis socks and $300,000 watches, and the entire range. Our challenge, actually, Francine, is making choices with all these opportunities. But if you kind of ask me, well, yeah, sometimes the hardest answer is no, not now. We'll do it later. Certainly, if you look at the macro numbers, the biggest opportunity for us is women's wear. So this company was built on menswear. That's the rock of the company, is the way I think about it. We have significant opportunity in women's wear around the world. We have a 3-brand portfolio, Collection at the high end, Polo Women's, and Lauren. We're seeing really nice momentum on that business. It's about a $2 billion business for us. The total addressable market, depending on how you do the math, is $150 to $200 billion. So significant runway. And our design teams are doing a really nice job with our marketing teams, developing product and storytelling that connects particularly to that younger consumer. Nothing makes me happier than to see a young 18-year-old walk down the street with our Polo Bear sweater and a pony cap.
I mean, when you talk about storytelling, is that through social media? Is it people that come in store and actually want to know about the story, or is it other channels?
So it's evolved greatly, and you and I have had a chance to talk about it over time. But from a more traditional kind of fashion show, print magazine, activations, to now a broad range of programs. Sports, right? Obviously, Wimbledon, US Open, Ryder Cup, Australian Open. We have great partnerships with Lando Norris, who just won the British Grand Prix, with Aaron Judge, who's doing an awesome job with the Yankees. So that's part of the activation, really focused on spectator style. Then we have a lot of activations in gaming, right? We do things with Fortnite. We have a number of different things going on right now in different platforms. Celebrities, right, who have an authentic relationship with us. And then there's the experience in store and online. And what we are really focused on is to make sure we're creating this environment where you can step into your dream, right? This company is all about dreams, much more than it is about apparels. And how do we create these experiences that help people think about something different than dream?
Patrice, I remember, a couple of years, actually maybe 2 years ago, you telling me what's important about Wimbledon, because we're in full Wimbledon fever here in London, is that you turn the camera to look at spectators, and you see that, like, every day you have images of celebrities showing that. Is there another sport, or is there another industry where you could do the same, where actually there's, the fashion luxury world and this other industry become much more powerful combined?
Yes, and again, it's a question of choices for us. So we're in golf, right? We actually are the outfitter of the U.S. Ryder Cup team. We also have a number of golf players. We have opportunities that come across many different sports. We're looking at cricket as a potential opportunity. There's an important game happening today. So again, for us, the point is, where is our target consumer? Where do they want to engage with our brands? And how do we make sure we're there? Formula One obviously is an important area. That's why we're really excited to have this partnership with Lando Norris, who happens to be doing quite well this season.
But so how do you choose? And again, I mean, Formula One is seeing a massive revival thanks to Netflix.
That's right. We choose through being laser focused on the consumer we want to talk to, and understanding from him and from her where they want to engage, how they want to engage, and then we make sure that what we offer is unique and distinctive and authentic.
Patrice, how's the Asian consumer doing compared to the European?
So there's a lot of conversations around China's consumers being pressured, for example. And obviously we see that holistically, but our business continues to be quite strong across Asia. The standout is clearly China for us, 20% up last quarter, 20% up the quarter before that. I think our teams on the ground are doing a great job connecting with that consumer, that younger consumer, evolving the storytelling that's still very authentic to who we are, but really resonates with them culturally. But we're seeing that in Japan. Japan is quite strong for us right now. We're seeing that in Korea, also great performance there. We're seeing that in Australia. Now I'm really pleased to see the work the teams are doing around the world.
What's your biggest challenge? I don't know whether, there's currencies, there are things that are completely out of your control, like exchange rates. I mean, do you worry about them? Do you hedge, or do you just, so, it is what it is?
As a philosophy, Francine, we really say let's focus on what we can control, right? Because we could spend a lot of time chasing things that are out of our control, and that's not good use of our resources and our energy. Well, the greatest concern, I think, for all business leaders right now is the uncertainty, right? And we like to have some visibility so we can plan accordingly, and obviously there's a great deal of uncertainty. When it comes to currencies, we guided in May that we expected currencies to be roughly even impact for the fiscal year. There's been some movement. We'll update the street when we announce our results in a couple weeks. We do hedge. But at the same time, we're also clear on what we can and cannot control. And I think, as we've been talking, the focus for us is get the consumer excited about what we have to offer, get them engaged, and good things will happen as we do that.
In a world of seismic change, will your business shape the future or be shaped by it? How will we capture the imagination of tomorrow's consumers? Harness technology and AI to shape the way we live our lives, and unlock economic and social prosperity through environmental responsibility. With EY's full spectrum of services across sectors, we're all in to shape the future with confidence.
It seems like Chinese markets have been doing quite well this year, despite all these tariff threats.
Yes.
Is it complacency, or do you think something like this is sustainable?
Well, I think first we need to understand what is doing well, all right, which segment. The tech space, right, DeepSeek movement definitely have driven more investor interest onto the space. Apart from it, the yield sector, like utilities, banks, those that give you like used to be 8 or 9% dividend yield, and now it's like 6-ish. Comparing to the China government yield, less than, I think, 1-ish, or maybe lower. So that actually have drawn investor interest to the space. So, but if we start looking at the underlying economy, yes, the tariff truths have extended the sort of rush of export order, the taco trade, that people being a little bit more complacent what will happen to tariff. So all these have helped the overall first half 2025 performance.
But moving into the second half then, what's your expectation? It doesn't sound quite as optimistic, or at least a lot more selective.
Well, I think if we look at what people talk about tariff, now we have more of this sort of pre-August 1st, some of the tariff coming through. Looks like market expectation is, except China, 10 to 15, China 35 to 40. So this is sort of expectation. If it is worse than that, or if they play some tricks about transshipment, like what they have done in Vietnam, that would affect China as well. What would they do with Mexico transshipment? All these other places targeting China, that will also be a swing factor. Apart from that, third quarter, fourth quarter, for sure, in terms of GDP growth rate, we have an easier base from last year. So it shouldn't be that bad. It may not be over 5%, but overall, I think definitely better than what expectation is at the beginning of this year.
There's a lot of talk domestically about what's going on, fierce competition, involution, and the like.
Yes.
Do you see these price wars being more dangerous than what we're seeing externally in tariffs right now in China?
The weakness in PPI, the CPI, like the deflation impact, even before the tariff has been an issue. Remember last year we had that sort of negative figure. Now for sure it would affect some of the export. Some of the orders cannot ship to the US, right? So these will stay in China, or maybe they will sell it to Asia. But that deflationary impact, for sure, is one of the key concerns amongst a Chinese leader. That's why they started off with these sort of, they describe it as supply reform onto steel, onto the solar, on specific sector. They know that supply is already ample. But the difference now versus 2016, when they was quite successful in supply reform. This round, it's a lot more challenging because the supply sources is a lot more fragmented. So in order to really, of course they already started to slow down the supply, cut that, cut this, but whether that will be eventually reflected into inflation or stopping the deflation, I think it's not as easy as it is.
In a world of seismic change, will your business shape the future or be shaped by it? How will we capture the imagination of tomorrow's consumers? Harness technology and AI to shape the way we live our lives and unlock economic and social prosperity through environmental responsibility. With EY's full spectrum of services across sectors, we're all in to shape the future with confidence.
Standard Chartered seemed to have a bit of an anti-consensus view in terms of the market balance in Q4. You actually see the market being balanced, versus most of the other analysts I've spoken to see the oil market moving into oversupply territory by the end of this year. Why are you relatively bullish?
Happy Friday, Jumana, and thank you for having me back on the show. I think where we are a little bit more bullish is on the global demand front for oil, and this is also what we've been hearing from various OPEC members, a quite constructive view on prospects for global oil demand growth. We've just published our global focus report, so our global outlook for the second half. And when we scan by regions, our expectations, our forecasts for the second half of the year by way of growth, we still see growth in Asia of around 4.9%, the Middle East as well, another bright spot, specifically the GCC. So this is in comparison with major developed economies where we see lower growth. So what this means as a global oil demand picture is that we're still quite constructive. We're not expecting a global recession or a large global slowdown. So this should bode well for the fundamentals, which appear to be being priced in the oil markets today.
Yeah, the big one obviously is Saudi Arabia, and most of the voluntary cut putback has actually come from Saudi Arabia, the lion's share of it. What does this all mean for Saudi's finances?
We've already seen the first quarter fiscal deficit for Saudi coming in slightly on the higher end. We expect to see the fiscal deficit widen compared to the projections, and this should translate to higher leverage, not just at the sovereign level, but also at various levels of economic sectors. So we expect debt and private credit to increase in Saudi. The big question is as well, how is the reaction function of Saudi policymakers? Are we going to see investment plans being pulled back? What's the reaction function? We believe there are two factors that could change the macro outlook for Saudi. First is if the fiscal deficit crosses 4% and inches closer to 5% of GDP, we believe that would cause the macro outlook to change and investment plans to change. And then if public debt to GDP starts suddenly rising faster than expected, closer to the 40% internal mark, that self-imposed debt ceiling that Saudi has.
Yeah, interesting. You know, speaking of debt dynamics, another story that caught my attention overnight, Moody's has upgraded Oman to investment grade. They state in the statement, they say the upgrade reflects our expectation that Oman's government debt metrics will remain robust even if oil prices moderate below our medium-term assumption of $65 a barrel. Was this expected, Carla?
This was very much expected, Jumana, in the sense that when we look at the debt dynamics across the GCC, while on one hand we have debt in Saudi rising gradually, slowly but surely, in other parts of the GCC, we've been on a multi-year deleveraging effort where you have sovereigns like Oman, like Qatar, like the UAE to a certain extent, that have put a lot of effort to use fiscal surpluses, budget surpluses, to pay back debt. And this has translated into positive outcomes for credit ratings and upward pressure in credit ratings. So the Moody's upgrade was very much expected for Oman, and we should expect to see more of these pressures across.
Interesting. I want to turn to tariffs and the impact that it's having across the region. And I wonder to what extent the perhaps indirect impact of tariffs, or even direct impact of tariffs, influenced Egypt yesterday when the Central Bank of Egypt surprised everybody by not continuing with the easing cycle.
You're right, Jumana, it was a surprise. Going into the decision, the market was quite split. We had various analysts calling for a 100 basis points cut, which we were in that camp. And we had various analysts also calling for a pause. Now, with regards to the tariff impact specifically, Egypt managed to actually weather the global market wobble after the tariff package was announced in early April. So we've seen the easing cycle proceed through the tariff uncertainty. At the moment, what it seems to look like is that Egypt is a little bit concerned that the fluctuations in its inflation prints have put inflation in a sort of uncertain territory, specifically with regards to how the fiscal reforms are translating. We know that the IMF program has delayed the 5th review and combined it with the 6th review. So there could be more fiscal reforms coming in that could be slightly inflationary, and the central bank may have decided that it's better to err on the side of even more caution after it had already made the size of the easing clip smaller from 225 basis points to 100 basis points. So really a very cautious central bank yesterday.
In a world of seismic change, will your business shape the future or be shaped by it? How will we capture the imagination of tomorrow's consumers? Harness technology and AI to shape the way we live our lives, and unlock economic and social prosperity through environmental responsibility. With EY's full spectrum of services across sectors, we're all in to shape the future with confidence.
The former US Vice President Mike Pence taking a critical stance on President Trump's tariffs, writing in a Wall Street Journal op-ed in the past few months that since the president announced his Liberation Day tariffs, the only thing America has been liberated from is trillions of dollars in investments. I'm pleased to say the 48th Vice President of the United States, Mike Pence, joins us now for more. Mr. Vice President, good morning.
Good morning. Thanks for having me on.
Thank you for being here. I want to pick up on a question I know you've been exploring. What can 47 learn from 45? Let's start there and talk about trade.
Well, first off, I want to give President Trump all the credit in the world for a historic political comeback. But in that Republican primary, I was traveling as a candidate in 2023. I mostly heard people saying we want to get back, in the midst of the failed economic policies of the Biden administration, we want to get back to what the Trump-Pence administration was advancing. And so in the Wall Street Journal, I gave the president great credit, high marks for securing the border, for restoring morale and recruitment in our military, for taking the fight to the Houthis. Since then, we'll talk more later, I'm very encouraged about the strong stand that the president is taking on the world stage, particularly in the Middle East and in Eastern Europe. But what I wanted to call attention to was the policy toward tariffs was changed with Liberation Day. During our administration, we used tariffs and the threat of tariffs, principally focused on China, to leverage changes in behavior. But the objective was to essentially lower trade barriers and expand trade. And in this administration, I think what we saw several months ago, now it's paused again happily, is the kind of broad-based industrial policy that I think ultimately will harm the American economy, will harm American consumers. And so we've spoken out against it. We've tried to take a stand. What I like to say is free trade with free nations, be tough on China, be tough on trade abusers, but have the objective of ultimately lowering trade barriers. And that's how America wins and prospers. That's how we won during our first term.
You've identified that change. What's your understanding of what's behind it? What's led that change?
Well, I think that what's changed is that I think the president feels, at least I perceive it. You know, sometimes I tell people, like, I know President Trump better than his most ardent defenders. We served together for 4.5 years. We had a close working relationship. And I've said many times that President Trump is not an isolationist. He is someone deeply committed to free market capitalism. But for all of his career, he has been very sympathetic to protectionist thinking and philosophy. You can go back 30 years on YouTube and find Donald Trump saying the same things that President Trump is saying today. Now, he and I had many vigorous conversations during our 4 years about trade. I come from one of the leading exporting states in the country. What we make, we grow in Indiana, we sell to the world. But at the end of the day, I think what you're seeing is not different influences around President Trump. I think you're simply seeing him extending out into a philosophy of government and economics that he has long believed.
Were these impulses then there when during the first administration, and individuals like you maybe talked him out of it?
Well, I don't know that it was. I mean, there were a few times that I saw him change his mind on things, but I think it was more about priorities in the first term, to make sure that we passed the tax cuts, rolled back regulation, unleashed American energy. And we changed the national consensus on China, China with its years of trade abuses. And I played a leading role in articulating that in the early going. And I'm incredibly proud of that record and glad that at least the Biden administration didn't change the tariff policy toward China. But for me, it was more about driving toward free trade agreements. I had the privilege of announcing the beginning of a free trade agreement with UK in the city of London. We renegotiated a free trade agreement with South Korea that's back in the news this week with new tariff threats. And I was leading with my counterpart in Japan. I was actually tasked with leading a working group for a free trade agreement with Japan. So for us, it was. We saw an expansion of trade and opening markets as a key part of American growth. And right now, I actually believe that President Trump is driving toward a long-term change in industrial policy in America, where he sees permanent unilateral trade tariff barriers as beneficial to America in the long term. And I, as a free market conservative, it's something I just don't embrace.
Can you do that and isolate China with the rest of the world on board at the same time?
Well, Anne-Marie, I think that's the right question Senator Phil Gramm we had on Capitol Hill with our foundation yesterday, had over 100 staffers that came out to hear him. He had probably the best description of it. He said by going after all of the free nations that you're trading with, at the same time that you're trying to bring China farther along into opening markets and ending years of trade abuses. He said it's like dismissing your front line in a football game and expecting that you're going to take on the other side. Look, we need Japan. We need South Korea, we need Australia, we need the EU to continue to bring the kind of economic pressure on China that I believe is all that President Xi and the Chinese Communist Party will respect. We saw some change. Remember that phase one trade deal in the early days of 2020? Most people have long since forgotten it. There were bigger stories that year by far. But we saw when we imposed those $250 billion in tariffs, the Chinese came to the table quickly and began negotiations. And I still believe that's the right approach, with free trade with free nations being the backstop.
Mr. Vice President, I want to pick out a line in that Wall Street Journal op-ed that John was mentioning that you wrote. Mr. Trump's proposed tariffs would be the largest peacetime hike in American history, harming consumers and driving inflation.
Right.
President Trump, his administration has been talking about they're not going to be inflationary, that the producers in other countries are going to absorb it. Right. Are you seeing evidence that that's not the case? Are you really concerned about what this does to the economy?
Well, I really am. And I understand that that's the debate right now. We haven't seen the inflation from Liberation Day. And I think there's several reasons to explain that. Number one is the tariff regime was paused and has now been paused again. And the markets are responding to that, and businesses are responding. Secondly, I got to tell you, the businesses I talk to as I travel around the country have been spending an awful lot of money on inventory right now. You know, there's an old saying that, where I come from, that, I was born in the morning, but not yesterday morning. So people say these tariffs are coming, so why don't we fill the warehouse right now? And I think that's wise. But at the end of the day, I also think that the president on Liberation Day talked about 25%, 50%, 70% tariffs on countries. And seeing some of these early frameworks that end up, like with the UK, with 10%, there's a temptation to say, well, that's just 10%. And so I think that's the reason why that's why businesses have not adjusted prices yet. But if we have a unilateral tariff of 10% on the American economy of all imported goods, that's 4 times the average tariff today. And the reality is that I watch, I spent a lot of time in that cabinet room. I watched a little bit of the cabinet meeting this week, and I saw Secretary Bessent speaking very glowingly about the projection is $300 billion in tariff revenue this year. Well, tariffs are a tax, and American importers and businesses and ultimately consumers pay almost all of that. And so literally a week after we managed to extend the Trump-Pence tax cuts and prevent a $2,000 tax increase on working families, the administration is right now boasting of the fact that that the average American household is going to see about $3,000 increase in the cost of goods, because we're paying that. So that's why I referred to Liberation Day. I said could well be the largest peacetime tax hike in American history. We've been pushing back on that. I welcome the pauses, but I really do believe the antidote here is free trade with free nations. Tough on China, but continue to drive toward lowering trade barriers and non-tariff subsidies.
You referred to the inflation risk. The White House would also like this Federal Reserve to cut interest rates. You've been in the room a few times, I'm sure, talking about this Federal Reserve. How did the president end up with a Fed chair that he dislikes so much? How did that happen?
Well, I've been watching a lot of what the president's had to say about Jay Powell lately, and he did appoint him, so it's part of the awkward aspect here. Well, first, I think the President of the United States is fully entitled to express his opinion about both the Fed chair and about the Federal Reserve itself. I have long had great concerns about the dual mandate in the Federal Reserve. I think it confuses the issue. I mean, the Federal Reserve has this, for your viewers, has a dual mandate to protect the integrity of the dollar and achieve full employment. I think the Federal Reserve ought to just focus on the dollar. And I think that the hesitation that I have seen from the Fed chair and ostensibly the committee is that the uncertainty around these broad-based tariffs and the potential for inflation has slowed their intention and their earlier efforts at lowering rates. And so how the president got to where he considers the Federal Reserve Chairman to be worthy of the nickname "too late," I can't really testify. But to me, pushing back on the idea that what seems to be holding up the Federal Reserve, although I read this morning that there's now more vigorous debate, I'm sure you've covered here on Bloomberg, on the committee, that we may have a lowering of interest rates, which we certainly would welcome.
As you know, the president, one of his greatest strengths is to break the status quo and have very little respect for it. Are there limits to that? And is Fed independence an example of it?
Well, that's right. And I think, look, the president appoints the chairman of the Federal Reserve, and a careful study of American history shows I don't really accept that the Federal Reserve should be a completely separate agency, like a college of cardinals that we never refer to other than in respectful hush tones, John. I think the president ought to be able to express himself. Elected officials ought to be able to express themselves, because it's almost like that old saying about the Supreme Court, that justices do read the newspaper. And I expect that's also true of members of the Federal Reserve.
You have taken a balanced view on the current administration. You've been somewhat critical of trade. We've discussed that. Mm-hmm. I would say a ringing endorsement about their approach to the Middle East. So let's talk about that.
Yeah.
Where you were in your first term with the president, where he is in his second term, and what went wrong in between, from your standpoint, on the Middle East?
Well, I just think when Joe Biden returned to a policy of appeasement toward Iran, it really emboldened the enemies of Israel across the region. I traveled to Israel in about 6 months after October 7th and saw what occurred there. And I would tell you, it's one of the things I'm probably most proud of in our administration. Not only did we change the national consensus on China, but we were probably the most pro-Israel administration since the reestablishment of the State of Israel in 1948. There's just simply no recognizing, moving the American embassy to Jerusalem, recognizing the Golan Heights. These were all historic achievements that everyone told us would foment violence and discord across the Middle East. But again, another 2020 story that is long forgotten by many people is the Abraham Accords. I mean, we actually demonstrated that when you stand without, in an unwavering way with Israel, that I call our most cherished ally throughout our history, it sends a very clear signal that makes peace more possible, not less possible. We also isolated Iran as never before. We unleashed our military to take down the ISIS caliphate. And of course, the president made the decision to take down Qasem Soleimani, the head of the Iran Revolutionary Guard. All of that had Iran on its back heels. The Biden administration changed that, went back to the Obama approach of re-engaging with the mullahs in Tehran. I think they were emboldened. The violence that we saw, whether it be October 7th with Hamas, one of their patron groups, or the Houthis, all were a result. I've always believed that weakness arouses evil, but peace comes through strength. And the weakness of the Biden administration, I think, created the conditions for the mayhem that the new Trump administration inherited. And that's why I've been so encouraged to see the strong stand the president has taken with Israel. We publicly encouraged the use of American military assets. If Iran was not willing to dismantle their nuclear program, I believe it needed to be destroyed. And I commend the president for his decisive leadership and our incredible airmen who delivered those payloads.
You welcome those strikes on the Iranian nuclear facilities, but the president still talks about a deal with Iran. Do you think he'll do a deal at any cost?
Well, I hope not. I said in that Wall Street Journal piece that you cited, it was about 2 months ago, and one of my concerns, in addition to some of the tariff issues that we talked about, was that a lot of what we were hearing from the administration in the first 100 days sounded an awful lot like a new Iran nuclear deal. And we pushed back on that pretty hard. My hope is that the president, having seen both the run-up to the need for American action and also the response by the mullahs in Tehran, he'll keep his hand on the holster and look ultimately for achieving the objective that has been the stated U.S. policy through multiple administrations, that Iran can never be allowed to obtain a nuclear weapon or have a nuclear program of any kind.
When it comes to foreign policy, you've been very critical and hawkish on Russia. In the debate, when you were running with President Trump in the first term, you called Putin a small and bullying dictator. Why do you think Trump has only just started changing his tune when it comes to Vladimir Putin?
Well, I've never had any illusions about Vladimir Putin.
No, but President Trump has.
Well, that remains to be seen. I would tell you that, I was on the Foreign Affairs Committee when I was in the Congress. Been a student of Vladimir Putin. He's never made a secret of his ambitions in Eastern Europe. It's something he's spoken about, written about. His aim has always been to reestablish the old Soviet sphere of influence in Eastern Europe. And I really do believe it was our administration in the Trump-Pence years that were the first to literally provide lethal aid to Ukraine. I think that's what discouraged Putin from crossing that border during those 4 years. I think it continues to be the only pathway toward peace today.
But forgive me, Mr. Vice President, to go back to Anne-Marie's question, what's changed? Because right now we've seen a president who's warned against Russia crossing certain red lines that Russia's crossed, and then the sanctions haven't come.
Right.
What do you think is going on?
Well, I'm hopeful that they will.
What makes you hopeful?
I am. I've seen some statements by my friend Senator Lindsey Graham, who just in the last few days said that the president told him to move the bill. And these new Russia sanctions, which are secondary sanctions against people that are doing business with Russia, that are subsidizing the war effort by oil purchases and energy purchases, I think can be enormously impactful. But I would say that I've made it very clear that my deep conviction is Vladimir Putin doesn't want peace. Vladimir Putin wants Ukraine. Despite the stops and starts that gave many of us concern, including that famous Oval Office meeting between the president and President Zelensky, who I came to know well, I sense that my old running mate is coming around to recognizing Putin's real intentions here. I mean, I think that the clear irritation in the president's voice of having a conversation, and then to see some of the worst drone attacks launched in Kiev within a matter of hours is, I think, having its effect. But look, I just think that I was pleased that the president countermanded what had been a pause of aid to Ukraine last week, which I think was unfortunate wherever it originated. But I commend the president for reversing that decision. And my hope is when the Senate reconvenes that Senator Thune will put the Graham bill on the floor and put it on the president's desk. I think it's time. And it's my judgment. I've met Vladimir Putin. I've stood with him closer than I'm sitting next to you. I've told him things he didn't want to hear. And I think he is not a man who understands anything other than strength. This is a moment, I think, where it's in the interest of our country, it's in the interest of our allies in the region, and long-term peace in Eastern Europe for us to continue to provide military support to Ukraine to put punishing sanctions on Russia until a just and lasting peace can be secured.
In a world of seismic change, will your business shape the future or be shaped by it? How will we capture the imagination of tomorrow's consumers? Overcome operational constraints to focus on future growth? And unlock economic and social prosperity through environmental responsibility? With EY's full spectrum of services across sectors, we're all in to shape the future with confidence.
What started out as just a relief rally is starting to become something real.
The markets are adjusting. There's no panic so far.
If you're looking at what's been working in markets the last couple of years, it's quality stocks.
The market is pricing in a friendly sort of mix of growth, inflation, and policy.
Equities and risk are discounting the here and now.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Friday, the president emboldened. President Donald Trump encouraged by equities sitting at all-time highs as the White House eyes blanket tariffs of 15 to 20% on many trading partners. The JP Morgan boss, Jamie Dimon, is warning of complacency in financial markets. A little bit of tension heading into the weekend.
A big game of chicken between the president and the markets at a time where President Trump, in a conversation with NBC News, said, I think the tariffs have been very well received. The stock market hit a new high today. If the stock market is reflecting how well there is in the markets, these tariffs are being priced in, then what kind of risk off do you need to get the president's attention at a time when many people are looking past it? And the stock market is not the economy. It is composed of a lot of big tech stocks.
This is such an important distinction going into August 1st. The president takes a look at record highs on the S&P 500 and sees it not as a dismissal of his policies, but as a endorsement of his policies. That's a major difference.
And right now, there is a question of whether there is going to be some sort of break that's going to get the president's attention, or whether ultimately he's looking at a measure that is imperfect when it comes to exactly how the tariffs are going to be received by the economy. This is a huge tension at a time where people have continued to say the president backs down at the last minute. Will he back down if the market's complacency is giving him the green light?
So we'll be talking about those comments from JP Morgan's Jamie Dimon throughout this morning. And there are many, including this line. I have a lot of friends who are Democrats and they're idiots. We can build on that later on in the hour. Also on the complacency line, there's a big difference again. I would say some division in the C-suite between what Jamie Dimon of JP Morgan is saying about the risks around the economy and what we heard from Ed Bastian of Delta Airlines just yesterday.
And this goes to the K-shaped economy, and we're going to be talking a lot about this. There is a cohort of individuals emboldened by what we're seeing in the equity markets, helping their wealth effect to really boom, and also seeing their earnings go up at a disproportionate pace, according to what Neil Richardson is saying. They're the wealthier individuals, and they're continuing to spend, and they're continuing to spend on premium offerings at a lot of the airlines. And then you have the lower income consumers that are struggling. How do you deal with that when you look at the aggregate data showing a totally benign backdrop? And this is this is the conversation. How do you measure what is becoming an increasingly bifurcated economy, both from a corporate sector with the bigs and the smalls, as well as the economic sector within the consumer economy?
A record high in the equity market coming into Friday. We're pulling back this morning by 0.7% on the S&P. Coming up this hour, we'll catch up with John Stolfus of Oppenheimer with stocks back close to all-time highs. Sami Sith of Raymond James on the airlines following Delta's bullish forecast. And Ed Al-Husseini of Columbia Threadneedle on the chances of a July Fed rate cut. We begin this hour with stocks lower as President Trump ramps up tariff threats. John Stolfus of Oppenheimer writing, our intermediate and longer-term outlook remains decidedly bullish. We believe U.S. economic fundamentals remain on solid footing. John joins us now for more. John, good morning.
Good morning, John.
So pick your favourite CEO right now. Jamie Dimon says it's complacency. Ed Bastian says we've got stability. Which one is it?
Somewhere in between. How's that?
That works.
It's bifurcated, and I think what we notice is related to market capitalization, style, as well as when you consider the sectors. There will be very big differences if the tariffs come out at the higher level among companies. Some will have great workarounds, some will be unscathed, and some will likely get hit. So it looks like a stock picker's market here. or even an index. It could be better ultimately for technology and materials, for example, on expectations of what is to come beyond.
Let's talk about earnings. Max Kettner of HSBC, just in the past day, writing this, buy more. We increase our overweight to equities further and prefer the United States the most. Risk assets are set to remain supported with lower sensitivity to tariffs going into Q2 reporting season. Following Delta, did that bar come up just a little bit?
Yeah, I think the bar does come up a little bit when we look forward beyond. The later we get into Q2, I think, is when we begin to see perhaps some effect, at least in anticipation of what's coming forth. But our viewpoint has been for a long time that where we are today, it's be overweight U.S. We've been that way for years. We are moderately exposed, what we say is meaningfully exposed to the international, both developed and emerging. But we think it's the U.S. We don't think it's the end of U.S. exceptionalism. That's related to innovation, and also in terms of policy, is always a question if we consider the last 4 years and where we are currently.
President Trump yesterday, I just want to pick up on the comments that he made yesterday evening when he said, I think the tariffs have been very well received. The stock market hit a new high today. Does his getting a green light from the stock market make you feel good or nervous?
I think it makes me feel good in that I think the market is giving this some time. It's giving some consideration. We already had the great nervousness of April 2nd, and it had already begun on February 19th when the market began to move lower, and then it accelerated, hit a bottom on April 8th, and it's pretty much rallied since.
Okay, so then you reject Michael Hartnett of Bank of America, who said in a note this morning that really the complacency that Jamie Dimon was talking about has to do with stock traders' belief that Trump always chickens out, that ultimately he will back down and the rates that he's been putting out will be substantially lower. Do you think that is true, or do you think that this market is adequately pricing in the rates as we've been hearing as they've been trickling out over the past few days?
I think thus far the market has been adequately pricing in the risks if it considers Scott Bessent's influence at the White House. And also, I don't think that where we are today is that it's not so much the taco business. It's much more that I think that Trump is sensitive to where the equity market moves. Believe me, I'm not an apologist for Trump. I wasn't an apologist for Biden either. It's just, if you look at it as a strategist, what's moving the markets is the market would appear to say there's enough workarounds that we have moving here, enough within the sectors, within the market capitalizations, within style. There's enough to take us higher. And where we are today is really a realization, I think, that an economy that is $28 trillion to $30 trillion a year, the U.S. economy, is likely somewhat bigger than policy until you get to a certain level. Now, we have to wait. If we go back to those April 2nd and we settle on those tariffs, that could be problematic. But if we see negotiations continue, and, on this whole tariff business, I'm not thrilled about tariffs at all. But what I think about tariffs is to bring people to the table. What it reflects is that the U.S. has the biggest consumer in the world, essentially, the U.S. consumer, versus overcapacity in manufacturing throughout the world, which has been built for the last 40, 30, 20, 10, 5 years, most of which has a destination to the U.S. and is hard to replace because of the per capita income of the U.S. consumer, whether it's a small consumer or a big luxury consumer. The U.S. beyond the billionaire class is global, and they compete for the latest Rolls Royce with the ostrich seats, But otherwise, when you look at the Ferraris, but when it comes to like the pencil sharpeners, the lunch boxes, whatever it is, the U.S. has the consumer that'll pay more. China can say they'll say, okay, you won't buy it, we'll sell it to the emerging markets. It's going to be tough. The emerging markets don't have the per capita income to replace the U.S. buyer. And when it comes to other countries, especially in Europe, they have so much cost of socialism built into their businesses that the hurdles they have to overcome. Their consumer isn't as big as ours.
John, this president wants rate cuts. Yep. Does this market need them?
I don't think it does. I'm a big fan of Jerome Powell. I think he's done a great job. 11 cuts, 9 pauses. 11 hikes, 9 pauses and then 3 cuts. So far, no recession. Remarkable with inflation as sticky as it has been, and the target.
Is that genius or luck?
I think it's a combination of both. Again, I think it's never clearly bifurcated. It's like on this kind of thing, it's a mix. It just is. But I do believe that he's looking for his legacy is not to be remembered as the predecessor of Paul Volcker is remembered.
So, is there anything going forward if the Fed doesn't cut rates, you're not phased? If the rates that we're seeing in terms of tariffs go on, you're not totally phased. What would phase you heading into the end of the year at a time where a growing number of people are saying valuations are pretty high, a lot of expectations right now are baked in?
Yeah, I would say, it's if we see tariffs come in at those rates that are as high as they were on April 2nd, I think the market would have a real reaction.
But up until then,
but
even if it's 35,
then, and I also
40.
think the Fed has room to cut. And I think the Fed is willing to cut. I think they're going to cut 2 or 3 times this year. I don't think it's what the highly leveraged crowd wants to see. But I think it's somewhere between 75 bips and 100 bips. Another down payment from the Fed saying the hike cycle is ending, but don't expect it. We're not going back to 1 7/8 mortgages. This is more normalized interest rates where we're headed.
Hey, John, it's good to see you. Thanks for dropping by.
Great seeing you.
Thank
both.
you, sir. John Stelfus there of Oppenheimer on the Federal Reserve. It depends who you ask. If you ask Governor Waller, getting a very clear answer now, even with the recent labour market data, I think we're just too tight and could consider cutting the policy rate in July, then going on to say it's not political.
Yeah, saying that what he's looking at right now is the fact that tariff and the effect will not be a long term. It will be short-lived. I still
Take
can't.
your pick.
So I'm trying to sort of do the in-between, the short-lived.
I just go with what's natural. Short-lived just feels right to me.
I would agree with you, but I think that he's looking through this and seeing it as short-lived, and other people are not so certain. Mary Daly, who is on this show, actually repeating that and reiterating some of that belief, and also seeing maybe 2 rate cuts this year.
Might see some dissent in a few weeks' time at that Federal Reserve meeting. We'll see. If you are just joining us, welcome to the programme. All-time highs at the close in yesterday's session. We pulled back this morning by 0.6% on the S&P. With an update on stories elsewhere this morning with your Bloomberg Brief, here's Lizzie Burden. Hey, Lizzie.
Hey, John. President Trump is threatening a 35% tariff on some Canadian goods. The tariff is an increase from the current 25% level and would take effect August 1st. It'd be imposed on US imports from Canada that aren't shipped under the terms of the US-Mexico-Canada agreement. Trump also told NBC News that he's eyeing blanket tariffs of 15 to 20% on most trading partners. Elsewhere, Apple is planning a release of a line of new products during the first half of next year, including a new low-end iPhone, multiple iPads and upgraded Macs. A budget smartphone dubbed the iPhone 17e will be a follow-up to a $599 model that Apple launched earlier this year. And London's Heathrow Airport plans to invest over $13 billion over the next 5 years to upgrade its terminals and its services after the UK hub slipped in global airport rankings. The project would increase the number of passengers per year by 10 million, a 12% jump in capacity. And that should be my brief, John.
Hey, Lizzie, thank you. More from Lizzie in about 30 minutes' time. Up next on the programme, the President emboldened.
The open question that maybe we're getting a little bit of an answer to is if you get enough resilience in economic data and the stock market trading at all-time highs, does that beholden the administration to sort of press forward with tariffs?
Up next on the programme, John Lieber of Eurasia Group, live from New York City this morning. Good morning.
Progress never stops, neither should you. At PwC, we make sure you're ready for what's next, with the expertise and technology you need to outthink and outperform. We're with you, sleeves rolled up, start to finish, so you can stay ahead, so you can protect what you built, so you can create new value. We build for what's next, so you can get there now. PwC, so you can.
In a world of seismic change, will your business shape the future or be shaped by it? How will we capture the